80% of earnings are in, excuse me, 80% of stocks that have reported so far, they've beaten earnings, and yet it's like, yeah. I mean, that's what Laidler said. He said it just really hasn't happened.
It's the forward look, and outside of big tech, you've seen a lot of pain. And yesterday, Lori Calvasina was saying, it's
what did
unclear.
she say? I missed this. This is important.
What you're seeing is the Russell 2000 reach levels that we have not seen since November of 2020. That was before we had a vaccine. That was before we really reemerged from lockdowns. She's saying that the actual economics don't really justify that actually these companies are not doing that badly, that they're actually coming around a bit. But people still have a dramatic aversion to this risk. So the question is, do you go with sentiment or do you go with something more fundamental? And it's kind of driving people bonkers because you have something where you can make a really good argument, but it's going to be wrong in market practice.
I mean, I'm looking at the bank index right now. I took a couple days off, folks. I've lost track. Come on, BKX. Right in the bottom of 2023, not quite back to where we were in 2020.
It's the same kind of story. Basically, there is pain out there. It's just sort of masked by the behemoths that are sucking up our cash for children to have devices so that they can go around and be with their friends and walkie-talkies.
We've been having fun today. Kids, be careful out there tonight. Bloomberg surveillance.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think we see the UAW contract tentative agreement with GM, Ford, and Stellantis as being a very positive outcome of what can happen when the parties really work in good faith and stay at the collective bargaining table. What we are seeing is good faith negotiations leading to workers getting a fair share of the gains in these industries at a time when American companies are really doing so well.
Lyle Brainerd, the National Economic Council Director, managing the message from the White House. I'm going to suggest they got to be happy. Good morning, Bloomberg Surveillance, Lisa Abramowitz and Tom King. John Farrell, it's sort of like, when they get ready for the balloons at Thanksgiving, where the night before they lift the balloons on Central Park West.
They blow them up, yeah.
I went over once in Washington. It's very, very cool how they do that. I went over when you could get close to the balloons.
Yeah, before they cordoned it off, and then the crowds were kind of sectioned off.
Farrell is so all in Halloween.
Oh, yeah.
That he's takes, that's why he's been on a cruise and he came back. He says, I can't come in. I'm in preparation for his costume or whatever.
So we're going to expect some significant costume pictures tomorrow when
he's going
returns.
as Adele.
The Dow, yeah,
just so you know.
he's got lots of ideas for that. I will say, when you talk about the auto manufacturers and what happened yesterday, it does seem like a 7-week strike is largely over, and you're seeing a relief rally in some shares. Stellantis shares up, for example. ADR is going up about 3.3% this morning, even though they came out, reported earnings, and said that they saw a net revenue hit of about 3 billion euros from the work stoppages. So there are some feelings that there was some, loss, but not enough to really torpedo anything.
We walked away from the story, but Lisa, very quickly here before we go to Gabriella Coppola, to me, what's disappeared is a debate on EV. I mean, the basic news flow on EV over the last 3, 4, 5 weeks has been, okay, everybody that wants one's bought one, now what? And that's sort of an undercurrent here, like, let's get back to work and make gasoline and diesel engines.
There are a lot of questions here.
Yeah.
And I think their first question is, just on a union perspective, have workers gotten their fair share during the recovery as auto prices climbed at record levels? The second thing is, how do U.S. companies remain competitive with an emphasis on electric vehicle production when consumers don't all want them because they're outpriced or they're outranked? So there are these questions, these competing goals, and then is it wage or is it the other compensation, like benefits, like pensions, some of the other things?
We haven't covered this story with all the distractions. Gabriella Coppola doesn't have that luxury. Out of Southfield, Dearborn, and Detroit, she is up to speed on a big American strike. Gabriella, let's start there right now. How big is this strike?
Well, this was a historic strike. It has never happened that they struck all 3 companies at once. And it was a very different strategy than, in the past, they would just take one, like in 2019 when GM, they just went, one automaker and took out all their plants. But this was, almost, 47,000 people were on strike in total, if you add up all the different plants that were struck.
Do you feel that it's over? I mean, if I got a Bloomberg headline, GM reaches tentative deal with UAW, I guess it's Ford, it's Chrysler, and now GM. Is the strike over this morning?
Well, I think the leadership of the UAW and then the workers have to vote to ratify the agreement. So it's technically not over, but people are going back to work. And I think from early reactions of, say, from some of the workers at Ford who've seen the deal, people are really overjoyed. I think people can't believe what an incredible deal they got. There's really not I think, they didn't get defined benefit pensions back, or, I'm not saying it was perfect. And there's some people who still lost a lot, maybe in 2007, 2009, they want everything back. That's still going to be disappointing. But overall, I think it's a pretty, it's just an incredible deal for people. It's way, way better than what they got in 2019.
Gabrielle,
yeah.
There's a question about how much the UAW has gotten support outside of the union, right? Union membership doesn't really represent the bulk of electric vehicle production workers, particularly not in Tesla and certainly not at other manufacturers outside of the Detroit Big Three in the U.S. How much did this actually give the UAW clout in negotiating for a broader swath of employees?
I think it gives them the best shot they've had in a very long time, maybe ever. That doesn't mean they're going to be successful, but they do have, I think the union was negotiating with that goal in mind. We broke stories that talked about there was a magic number. They wanted to be able to show at least a 30% wage increase, which they basically got if you add the 25% plus the inflation adjustment that they won. That was something they wanted to be able to bring to other car companies. And especially at the bottom rung, because, the big issue with the UAW workers has always been that ever since the financial crisis, there were 2 tiers and there were temp workers. So, those great middle class jobs that are kind of the stuff of, political speeches and things like that, only part of the workforce had that. Other people, like if you're a temp worker, I met people on the picket line that, had started at $15.67 an hour, and they've been in that temporary status for years.
Yeah.
Not getting profit sharing, not getting 401k, not getting the benefits of a full-time worker. This deal brings all those people up, and I think that is going to be more attractive to I have to say, I personally am very concerned about that, just from my knowledge as a reporter, and just looking at the world and the people that I talk to, whether they be in finance or, auto executives, things like that. I have to say, like, it seems like the reaction on Wall Street, maybe people are just so relieved that this is over.
Yeah.
And they knew that they were going to have to pay up, right? I keep reminding people that over the past 4 years, these people didn't get any raises, or only what was contractually negotiated in their previous contract. So while inflation was popping, they were not getting those gains. So they knew, I think people knew they're going to have to pay up, but I think they're just relieved that it's over. But I think the competitors are concerned. That I think the companies are talking about how they're going to offset these new labor costs in other ways, which is fine. But I wouldn't put too much of the onus on the UAW. People often want to just blame, labor for all the automakers' problems, and I don't think that's at all fair. Certainly this makes it harder, but the tougher thing is, how do you go from making combustion vehicles at a very nice profit to scaling up electric vehicle production when you don't have experience doing it? You're working out all the kinks, and demand is softening because interest rates are so high.
Okay. Well, Gabriel, let's get out in front of this. Let me rip up the script here. Are EVs dead? With the news flow of the last 2, 3, 4 weeks away from the strike, as we go into 2024, are we going to see a massive adjustment in the American EV market?
I think, I wouldn't say dead. I think that the growth, they're still growing. It's that the growth is slowing. And I think you're seeing the car makers pivot to hybrids more because they've got to meet those stricter, emissions rules. I think gas is not that cheap. Gas is still pretty expensive. So, hybrids are very popular. They're doing very well right now. But there's no way that EVs are dead. I still feel like long-term, this is the future. I was talking about this with somebody yesterday. There's a lot of people that advocate, well, why doesn't the U.S. just stay on gas cars and kind of build our own little hermit kingdom over here and stick our heads in the sand? Just, don't do EVs because people don't want them. And you can't do that, because every day that you wait on that, another day that, China gets better at it and you're behind.
Gabrielle, I just got to say, you're an absolute trooper. You were at the Lions-Raiders game last night at Ford Field, and here she is on Bloomberg this morning. Gabrielle Coppola.
It was a great night. It was a great night for the Lions.
It was a great night for the Lions. Thank you for our Detroit Lions update, Gabrielle Coppola, as well. I watched a few minutes for Michael Barr.
I was just going to say, you're just basically doing a hat tip to Michael Barr.
They're 6-2. This is beneath the radar. Max Verstappen's winning in Formula One. The Tots are in first place Premier League football. It's completely drowned out by a 6-2 Detroit Lions into Thanksgiving football. Yeah. I could just see Thanksgiving football at the Bramall House. TV goes on at 11 a.m.
And just all day long.
3 games.
Very much
ending
so.
with the Cowboys.
The Bramall family more likely be out in the park playing football and tackling each other.
Oh, here we go, playing Frisbee or something.
With Berks on? Not quite.
Yeah. I played Frisbee.
Ultimate Frisbee.
I had a bottle of cold duck and played Frisbee when I was 17. And they said, "That's okay, Tom. Go skate."
I'm pretty bad at Frisbee. I've got to be honest. Yeah.
Pharaoh, you should see Pharaoh.
Oh yeah, he's an ace. He's an ace at Ultimate Frisbee.
Scary. It's scary.
I can see that.
John Stolfist, you need to be in the market. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Problem is that the market is losing confidence in any one narrative.
The fiscal support at both the federal and state level, I think, is reducing the odds of a recession.
The Federal Reserve needs to target growth that's under potential.
We think that the Fed is getting very close to being finished at this point.
We have to start having some very deep conversations about whether the inflation and the interest rate relationship will be stable over time. My sense is it's going to disconnect somewhat.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's about the American paycheck. From New York, good morning. Welcome back. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, Lisa Abramowitz. John is off exploring the Apple Store ahead of earnings on Thursday. And honestly, Tom, to me, we haven't talked enough about this. 30 minutes time, we get employment cost index at a time where wages very much in focus.
The jobs report after a Fed meeting, and the basic idea here is what does it mean for wages, not only salaries, wages, but also benefits. Of all the different indicators, ECI is the thing I look at the most. Not 60,000 feet, but 25,000 feet coming into Newark. You make you turn at Paterson, New Jersey, about that level. And what I'm looking at here is what is the labor economy doing? We're going to get a lot of information on that.
And this, to me, is sort of the big question mark. How does it matter at a time where the data, essentially the Fed is saying they're data dependent, but everyone has written off whether or not this is a live meeting and what it's going to take for them to raise rates further if more employment might be a good thing if we also get disinflation.
And also if we get disinflation. To me, that's the heart, is melding the two themes of our Fed meeting, our coverage tomorrow with Richard Clarida. And the basic idea here is that disinflationary vectors in place if you look at what we saw from the European Union this morning.
Right, although we we also saw the weakness in the European Union with a contraction there. At the same time,
so what are you going to do? Raise rates? You're going to stay as restrictive there, or the contraction and, you know, literally borderline European austerity? Does that work?
There's a big question about whether you need some sort of economic, I don't even want to say contraction, but pain, weakness in order to drive disinflation, or whether you could get both. And a lot of it hinges on productivity. We're going to be getting some data out on that front as well. At the same time, we're looking at the economic data of companies, and what we see time and again is they're able to raise prices and increase volumes. You saw this with McDonald's, and we saw this today with Caterpillar. So how much can you put together a Big Mac and you know, a Caterpillar backhoe? I don't know, but there is some sort of rhyming here outside of certain sectors like the airlines, where you're seeing that kind of strength.
Okay, that's there, but you know, the pricing power into a resilient American economy has been the shock of 2023. I want to get out ahead and say, what's the shock of 2024? And it's sobering to look at Caterpillar today, up, and then they pull it in as well. That's the outlook that maybe we need to adjust to.
Was the outlook so bad, or was it just that people are looking for weakness? Yesterday, what we heard from certainly Gina Martin-Adams was she thinks the biggest pain trade is actually a rally, is actually that suddenly something is going to happen.
Totally.
That's going to lead people there.
Well, futures up 10. I mean, leave the data check here, Lisa. The answer is futures up 10. I got a VIX back in under 20. You know, I mean, no one's looking for VIX 16, VIX 15. I mean, no one is looking for what Gina Martin-Adams is talking about.
Well, stocks have not been very volatile relative to bonds, and I think that has been sort of one of the big conundrums. Who's right here with stocks kind of looking forward and bonds, I don't know, kind of bouncing around. Just the idea that you get an 8 basis point drop in a 10-year, and that's not leading our coverage, 4.81%. We're just sort of thinking, okay, it's more volatility.
It's more volatility, exactly, precisely. More volatility within the market. I'm going to look at Brent crude, $88 a barrel. What's so great about our guest? I mean, I'm going as yield curve control. You're going as a toxic brew. You don't, George Bunker and Simon Ramo, before Mike Bloomberg, we had Bunker Ramos. And the Bloomberg, true story, folks, the Bloomberg shows up. There's a guy that kicked footballs years ago named Charles Gogolak. He goes, Tom, there's this new machine. And I'm looking at Mike Bloomberg and Tom Secunda's machine, and I'm going, God, it's gorgeous compared to a Bunker Ramo. John Stolfus is going as Bunker Ramo tonight, one of the old machines.
I don't even know what a Bunker Ramo is.
It's like before Bloomberg, you had a Bunker Ramo, and it was lousy compared to what you could do with bonds on the Bloomberg.
Well, John Stolfus also has been looking at S&P targets in addition to the Bunker Ramo, and he actually had previously expanded his target earlier, 4,900 at one point. Then the S&P entered a technical correction, and John Stolfus of Oppenheimer lowered his year-end forecast for the S&P back to 4,400, kind of where it was earlier this year from that 4,900 mark previously. John Stolfus has been listening to this and wants to weigh in on the Bunker Ramo and beyond, and I'll let you get to that. But first, I want to start to say, how much are you basically saying we've just run out of time to get to that 4,900 mark?
Yeah, it really is. We had to right size our expectations. We always suggest that to investors as they consider what happens when markets are roiled, so to speak. And what we've got to consider here is the calendar's telling us that we're getting close to a year end. The average rallies are positive. You know, we get positive rallies after a dip like we've seen traditionally or historically, but it's smaller amounts, and there's still lots of uncertainty that bears and nervous investors and those who are skeptics can use to take more profits out of the fabulous rally that we're still living off from the lows of October 12th of last year.
I feel like one strategist after another is basically coming on and saying, give investors a Prozac, because frankly, there is a lot of optimism. They're just not seeing it. How much can you really hinge on fundamentals if the sentiment is just so gloomy and prepared for the worst?
You know, the real problem is, I think that when you're in a Fed funds hike cycle, it takes a while before the marketplace gets a sense that the Fed is indeed not trying to destroy things, and that the Fed might actually succeed in its goals. The Fed isn't infallible, but the Fed has a remarkably simple a mandate, essentially, stable economic growth with maximum employment. Of course, what is it? A few weeks ago, I think it was the daily quote on the Bloomberg was Martin Scorsese, and it was something that like simple is the best, but it's the hardest to achieve. Well, that's what happens in a Fed funds hike cycle. But what happens is eventually the marketplace, and you can see it related to higher prices being accepted by consumers and business in that you were just mentioning before. There's a sense, okay, we can deal with this now, and we keep moving forward. The Fed has been so sensitive in applying its mandate that it hasn't knocked apart the resilience in the consumer, in business, and the overall economy. It's been extraordinary.
John, Michael McKee out with a brilliant idea on the Magnificent Seven. He's going back to the movies, looking at Yul Brynner, Steve McQueen, Charles Bronson, Robert Vaughn, James Coburn, Horst Buchholz, and Brad Dexter. I mean, they were the Magnificent Seven. What do you do with a modern Magnificent Seven? Is Apple going to deliver here? And if you're going gloomy 4,400, do you sell your big tech?
Well, I'm not gloomy of 400 at all. I'm just saying it's more realistic from here to the end of the year. Just wait until we put in our price target for next year.
Go ahead.
That'll be later on.
Well, good. No one's watching here.
Yeah,
come on, compliance at OPCO's not watching. Give me a number. Can you pop a 5,000 for next year?
Can't do it. I got compliance breathing down my back. But when we look at this, things are getting better, and we think we're going to see competition return in a lot of spaces. And competition is when all of a sudden you've got everybody is passing on the old higher prices, getting away with it, and then some guy in business or gal discovers the idea of, well, maybe if I give up a little bit what I get in per unit costs, maybe I can make it up big time in volume. And that'll happen across the sectors. But in the meantime, tech is empowering everything. And we don't mean it like in some kind of a moonshot. But in existence today, corporations are doing better, navigating very tough environments, whether it was the financial crisis, whether it was the pandemic, post-pandemic, the supply chain stabilization, getting away from one country's centricity in terms of the global supply chain. All of this technology is enabling a lot of things, both for the consumer as well as for business, and it's a dramatic change. That combined with sensitivity by the Fed, communication, transparency, that we think is, the Bernanke legacy that is still being practiced by Jerome Powell in his own way, has a positive effect.
I keep thinking the economy is not the stock market, and this is not necessarily a stock market that's representative of the broader economy. That really is maybe the Russell 2000 or the banking index, the regional banking index. Does your optimism bleed over to small caps, to the KBW index?
Well, I'd say not necessarily to the KBW yet. We've got to wait for the economy to show a greater sustainability going forward, and not as many concerns in terms of commercial real estate and subprime auto loans and things like that. But what we would say is when we look at this picture, overall things are getting better. It's being led by the large caps. But if we get to that point where we get to see the sustainability of the economic expansion becoming predominant in the picture, you're going to want to own smalls and mid caps, and you probably want to consider. For instance, we're near market cap agnostic in some ways because our goal is beyond. We're intermediate to longer term investors, and the valuations are ridiculously low in many quality indices of the small caps and mid caps.
John Stolfus, thank you so much. Greatly appreciated here. An important idea there. The graphic that Lisa put up earlier on radio was really profound about where people still are on an equity index, 4166 now, S&P 500. And Google, Stolfus gets us back to 4,400. But others are still, I mean, you wonder if Stolfus is out front of adjusting here what we'll see from Citigroup, HSBC, and Bank.
We're running out of time. That's just the bottom line.
It's just a date.
Here.
You know?
I mean, it's
Come
a
on.
date, and this is
What
one
are you
of the
doing
banes.
New Year's Eve?
I'm not sure yet. What are you doing New Year's Eve? You want to hang out and go around trick or treating?
No, yeah, really.
A month late, 2 months late.
Yeah, New Year's Eve, that's where it is. I mean, right now, S&P 500, market's lifting a Stolfus way, up 11, up 0.3%.
And coming up, we are going to get at 8:30 a.m. the employment cost index. And again, it sort of goes to this question, do fundamentals matter at a time where people are feeling gloomy? Is good news, bad news, all these fun things that you love talking about.
Thank you for the emails in. I mentioned Charles Gogolak. And this is cool. Charlie Gogolak, I worked with years ago. He was out of Princeton. He played for the Redskins and the Patriots. And his brother, I'm going to say maybe more well-known, was Pete Gogolak. And they get confused. They played one game years ago, 1966, where they kicked extra points, 1 point at a time. And between the two of them, they scored 14 points in one game. Between the two of them. I mean, it was like, the score is like 170 or whatever. But there's, there's a little bit of football history there. He was great. He was the first guy that introduced me to the Bloomberg terminal. And it was great.
Gogolak squared?
Yeah, Gogolak, showed it to me. He says, what's this mean? And I said, it means, getting a field goal bond trading is over. Mike Bloomberg is going to narrow the spread on bonds, and that's what Mike Bloomberg and Tom Secunda did.
It has been pretty wild to watch, especially because the tracking of the bond market has been such volatility over the past couple of months. Again, it keeps going back to, you say stocks, and why is the VIX not moving? The volatility has not been in the stock market.
Yeah.
The volatility has been in full faith and credit, which is what's been unmooring a lot of stock traders that want to just feel some sense of stability, and they're not getting it from the market that's supposed to be the deepest and most liquid.
I mean, the Merrill Lynch Move Index 60 is now center tendency 125. It's a double. The volatility
That's where the volatility is.
Did I do okay there?
That's fantastic. Yes, actually, no, but truly, this is the divergence that we've seen of the year. Bonds are more volatile than stocks, and this is new.
Yeah, this is new. What is new? A Fed meeting tomorrow, and then Apple earnings on Thursday. Good news in the equity markets 2 days in a row. It's Bloomberg. Good morning.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make a bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I couldn't be more thrilled to be working with Andy Saperstein and Dan Simkowitz, two of my closest friends. They are extraordinary leaders. They're going to drive these businesses.
I'm glad you mentioned Andy and Dan because a lot of questions here around, they were two CEO candidates. Now they're going to be the co-presidents. How do you keep them around? Are you holding them to any lockup periods?
No, they've got phenomenal job opportunities. Andy's co-president. These are phenomenal opportunities. They're high-quality people. These are some of the best jobs on the planet, and, we're delighted to have them.
James Gorman, emeritus chairman, after he did his Tom Keene imitation there with Mr. Peck talking to Shonali Basak here a few days ago. Lovely to have you here this morning. October 30 this year, HSBC, they're in Hong Kong and Shanghai. HSBC sets aside $300 million extra for performance pay. I'm going to suggest in this uproar, everyone is doing this. Am I wrong?
In the last couple of years, we have seen these extraordinary bonus awards go to different executives at the biggest U.S. banks as well. Remember, when you're thinking about HSBC, something else is happening here. It's been a couple of years of really muted activity and therefore poor pay across all of Wall Street. What's happening here at Morgan Stanley is more in line of what we saw over at Goldman and JP Morgan, where there were tens of millions of dollars in special awards handed out, by the way, often contested by shareholders, but handed out to executives to retain their top employees.
Would they leave if they didn't get half this package?
That's the $1 million question, isn't it? Or
No,
the
it's a
$20
$10
million question.
Half the package is $10 million OMG.
Well, you know, you were joking right before we sat down for that interview. James Gorman was joking around with me and saying, there's nowhere to go. Where is everyone going to go? These are some of the most amazing jobs in the world.
He's brutal. I mean, I teared up.
You know, it is quite a moment, right, to see him step down after 14 years. But if there is nowhere to go, what do you need to hand them $20 million for is what I want to know.
And there is a potential lure from some of these smaller upstarts. I'm thinking of Pretium that took a lot of the Goldman Sachs alums away from that whole unit.
Sixth Street.
Right. So there are all of these shops that have started up, and especially if people want to feel like they're starting something anew. So the question is this something that people inside the firm feel like is an indictment of the culture, or is that making a mountain out of a molehill?
Let's look at it two ways. On one hand, these are promotions for each of these three men. One is becoming CEO, one is taking on another unit, and one is also gaining control of another unit and becoming co-president too. So there are promotions, but on the other hand, you do see Mike Mayo at Wells Fargo fighting back here, saying that, does this say something about the firm's culture that they need to keep them around via compensation rather than just the status quo? They are promotions in and of itself. The $20 million packages are essentially the average that all three men get for a year. And so it's $20 million on top of the $20 million that they would give or take get every year.
I imagine it's going to be rough for them to swallow the pill of not getting CEO when they're getting so richly compensated. But there is a larger question around culture and how to continue the culture after James Gorman, who was at the helm for so long through such difficult periods of time. Is that a concern outside of Mike Mayo's point, extrapolating from some of these financial remunerations?
Of course it is. And it's a concern for Morgan Stanley. It's a concern for many other shops that are losing talent at this place in time as well. You think about, for example, some of the very closely held talents that were at Morgan Stanley over the last several years, people that were close to Ted Pick, someone like Sam Kelly Smith, who is going to another hedge fund now that is starting up, or even Colm Kelleher, who is there, of course, his time.
He's got a job in Europe, right?
Well, at a big competitor now, isn't it? And
it's okay. You know.
It's okay. But to that point,
this is Sonali Basic's wheelhouse, folks. Let's clear the air here. Morgan Stanley, 80,000 employees, in a small, non-profitable upstart named Apollo, 2,500 employees. We talked to James Zelter in London. Are you telling me Zelter doesn't want to hire one of these beasts from Morgan Stanley
and by
to
the
jumpstart
way,
wealth management?
The special awards at a place like Apollo or even on some of these other private asset managers, they're not 20 million, they're like 200 million.
Okay, well, let's go there. I mean, that's the reality we're talking about. And they got 2,000, rounded up, 3,000 bodies. And Zelter's going, how do we get to 30,000 bodies in grain scale?
He has me wound up. One of the biggest question marks on Wall Street is, what does somebody like a Scott Kapnick have under his belt right now, because he started HPS. It's one of the biggest private creditor managers in the world. Is it going to go public? Is it going to sell? How is he going to create some liquidity for himself in this massive private credit shop that is only taking more share? Remember, this was a JP Morgan employee once upon a time, a Goldman employee once upon a time. How do these new firms keep creating wealth for their employees?
There used to be a hierarchy on Wall Street. And it used to be, you go to the credit rating company first, you get some information, now you get some skill under your belt, then you go to a big bank, then you go to a hedge fund or a private credit shop. That was sort of the trajectory of someone on a compensation scale. Am I correct?
Yeah.
Okay, so now the question is, are there going to be more questions asked about the remuneration at some of these private equity and private debt firms that have gotten very big and are raising money and that are facing some interesting times to deliver returns? And at a bank, if you can be safe and you can be secure and make that kind of money, you'll be challenged more, but it has that stability. How much is this sort of the equation that you hear people talking about?
And I have to say, even at the banks, when Jamie Dimon and Daniel Pinto's awards were contested by shareholders, it was a non-binding vote. They got the money anyways. And so even if money is contested, but to your point here, I think it's worth drilling into that. Private equity, hedge funds. The performance this year is not what it was last year or even the year before that. So then what happens? There is this sense in the market that there could be a much broader shakeout when you look at the private equity industry. I got a tip the other day that said, look at all the people that are losing their junior talent because a private equity firm gets eaten from the outside in and not the inside out. It takes a long time to figure out what the troubles are in this environment. As bankruptcies are starting to mount, they're putting more equity into their companies, and performance is shrinking year over year, and the cost of leverage is going up. Meanwhile, hedge funds have pass-through fees. They're asking their investors for money to pay their talent.
Are you going to see compensation headlines coming out towards the end of the year to get to February bonus? Is that are we in a food fight for the top 15% of people?
They already are, right? We already see them coming out. And by the way, that is paired with the culling, your favorite word here, the
yeah, 2 to 4%
culling.
annual culling. I mean, I get it.
Well, hold on a second, because that culling has been a little bit more than culling. I mean, we're hearing about cuts that are being quietly distributed under the hood. How much is this sort of an unequal distribution of wealth, where you have the people at the top who are getting paid a lot more, and people are getting cut on the bottom as AI takes over everything in between?
1,000%. And you have executives, at least privately, making no bones about it. That is exactly what they're doing. And they know they need to do it, because otherwise, how are they going to keep the people around who are making that extra dollar for the bank?
Are you going as a restrictive stock award for Halloween? Is that what you're going?
What does that look like?
That's you go down the box like a share certificate. You know, you're vested. You can wear a vest.
Right, I'm vesting. I'm vesting. I'll go downstairs and put one on for you for the next segment.
It'll be an RSU where the stock's not issued. Shonali Bassick, knowing the difference between RSU and RSA as well. Lisa, on what Mike Mayo wrought in the gossip column this morning.
Can I just say, I will get there in a second, but sort of these abstract concepts. There was someone in college who went as a Freudian slip and had a slip on with all these different, sayings on
Come
it.
on,
It
this
was
is
pretty
family
great.
radio, family television.
It was fantastic. All right, moving on. The whole idea of what Mike Mayo is reaping, there are a lot of questions here, which is how are they going to maintain a culture at a time where James Gorman had such a clutch on that, right? And they needed to bring in and keep some of their top talent, even if they were passed over from the top job. So that was sort of the question is, does this speak to a lack of commitment aside from money, which is viewed as a lesser commitment than some sort of inner passion? But I mean, on Wall Street, isn't it always somewhat about money?
It's all about money, and I adore Mike Mayo. Saw him the other day. We bonded and all that. But to me, I get what he's saying, but I'm sorry. This is the normal game. Everybody goes blah blah blah. McKinsey, fair compensation, and then you go, oh, we have to keep Andrew Sheets, or oh, we have to keep Dominic Constam, or Lisa Shallett, on and on.
Well, one person who is much smarter than I, who works in a recruiting field in Wall Street, said, the excess is not at the top, it's in the high-level middle, where people are replaceable and aren't necessarily driving the culture. And that, I think, is what you're seeing in some of this culling.
No, the culling, that's what we'll call it. 2-year yield, 5.01%. 30-year bond under 5% as well. Futures up 13, the VIX 19.20. On Israel, on Hamas, Aaron Miller, next.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Bloomberg Surveillance, Jonathan Farrow, Lisa Brownitz, and Tom Keene. Mr. Farrow in costume preparation. He'll be with us maybe tomorrow. We'll have to see as well. Bramwell here. She's going as Toxic Brew. I'm going as Yield Curve Control. It's working out. We're going to trick or treat together. Right now, a lift to the market. Futures up 13 and the VIX nicely under 20. 2 days in a row of better than good ability as well. Michael McKee with bated breath. We wait to hear about his Halloween costume, but first, employee cost index. Michael, you care about that, don't you?
We do care about that, and this one kind of sneaks in under the radar. One really important number before the Fed meets, not that it's going to really affect their decision this time, but the employment cost index comes in up 1.1%. That's a tick higher than it was in the second quarter. The internet page is overwhelmed at the moment, so we don't have the breakdowns for wages and things like that, but I'll get that for you in just a second, we hope. But it does suggest that employment costs have stayed about the same. Right. Now, let's see whether wages have gone down or not and benefits gone up. But the Fed is looking to see continuing decline in wage gains.
We have Michael McKee, vectors of disinflation. In the EU this morning, other American senses of disinflation. Is there a sense of disinflation in wages, in benefits?
Well, there has been. If you look at pretty much all the measures, the average hourly earnings, we'll get that on Friday. If you look at the ECI, even if you look at what we got in the GDP income numbers, essentially things have slowed down significantly. We were 4 to 5% for quite some time. Now we're in the roughly 4% range for wage and salary gains. Fed wants to see maybe 3 to 3.5%, but they're getting closer.
Okay, so what we're seeing in markets is really nothing much, although a little bit marginally yields a little bit higher, the euro fading a bit from some of the gains from earlier with the disinflation print out of the euro region. And what we're seeing right now, Mike, is basically a shrugging off of yet another better than expected U.S. read on the economy. And this comes as Canada's GDP is tracking back-to-back contractions in the second quarter, the third quarter. We could see a surprise contraction in the euro region. How long can the U.S. remain a lone ship in the storm around the world, continue with strength, and kind of disinflation, kind of not as much as people thought?
Well, if you have an answer to that, I have Jay Powell's phone number for you because he'd like to know as well. I mean, we don't know. There are a lot of reasons you can argue why the U.S. has been doing much better than everybody. Trace it back to pandemic aid. But how long can that last? Nobody really knows at this point because things aren't working the way they used to. Let me throw in here, just because we finally have it, compensation costs, wages and salaries up 4.6% and 5.1% for the year-over-year number.
It's a big number.
So for September 22, benefit costs up 4.1%. So we are seeing some gains there. Private industry workers up 4.3%. Compensation costs 4.5% for wages and salaries.
And you got to move here immediately with that breakdown here with a 2-year yield 5.04%. It was lower earlier. We're going to get back to a 30-year bond 5%. We're not there yet. 4.97% in equity futures, given a little bit. I mean, there's a bit of a surprise there of 4-ish, 5-ish wage growth.
A little Halloween surprise.
Yeah. What are we going as? I'm afraid to ask you as William Stanley Jevons or something.
22 years ago today, there was a murder. 5 years after that, it came back to life. I'm going to go as a 30-year bond.
Oh, very good. As a benchmark.
Yeah, benchmark. Yeah,
very good.
Which sets us up for your guest because he was around then and he remembers that was quite a day. That was a Halloween to remember if you were in the bond market.
We'll do that right now with the dynamics here of moving from a benchmark 30-year in tighter to a 10-year as well. Stephen Stanley joins us right now with Santander U.S. Capital Markets. You are acclaimed for analysis of GDP. How does the bond market affect your analysis?
You know, I think the Fed is overstating the importance of this little backup in bond yields that we've seen over the last month. As we talked about the last time I was here, I see it maybe as a little bit more of an excuse than a reason. I think they wanted to hold off, and that provided them with a convenient reason. Financial conditions have tightened a little bit, but look, you know, as you all discussed, the economy is still rolling at this point. So I think it's wishful thinking that the last 20 or 30 basis points on the bond yield is going to roll the economy over.
Okay, but I'll go with this easy question here. It's a cliche, but unfortunately it's apt right now. Are they fighting the last war?
I think it's too soon to say that because, you know, the idea, I assume what you're suggesting is, well, inflation's already licked.
Well, Dominic Constant in Missouri is calling it super restrictive. I got people saying the 5% reality lay on the bond market is a 7% reality in the economy as well. Are they working now? Are they go to the meeting tomorrow in a restrictive milieu?
I think policy is restrictive, but is it restrictive enough? I mean, until the economy actually slows down, until inflation really comes off, it's hard to say that. And so I think that's why that at a minimum, they're certainly going to want to keep their options open. You know, they've signaled another pause, but Powell has certainly kept the door open to further hikes.
So I'm going to throw this question at you, what I was asking before, which is how long can the U.S. continue surprising to the upside with economic data and showing momentum at the same time that you see Europe running into recession, Canada coming out recession, around the world, a lot of pain?
Maybe not to be overly glib, but basically forever, because the U.S. is a domestically driven economy. And I think economists and particularly the Fed have systematically over the years overestimated the importance of the global economy for the U.S. economy. We're, you know, between 10 and 15% of our economy is trade, whereas for most of the other major economies, it's 30, 40%.
Okay, I'll challenge that in one way. And this is something that a lot of people have been talking about, and I would love for you to push back if this is the case. People say that the international transmission mechanism is the U.S. yield, is how many international buyers are going to be coming in and picking up treasuries at a time where the Bank of Japan's not going to be buying, where you're going to have, or not going to be really pushing investors out of that nation's asset market, where you have certainly around the world yields going higher and China not buying. How much does supply change that narrative and create more of an international transmission mechanism than ever before?
Yeah, that's an interesting angle, actually. I think the root of the problem there, of course, is the fact that we're running such large deficits. If we had a smaller deficit, then this wouldn't be so much of a problem. But the fact that the Treasury has to borrow an extra $2.5 trillion a year, they need demand anywhere they can get it. So that actually does bring a good point, which is that it feels like the international community has pulled back a little bit for various reasons, and I think, you know, that's part of it, a piece of why yields have backed up recently.
Well, Mike McKee summarizes for us. We've heard this twice today on surveillance. Jill Moek of AXA and Stephen Stanley of Santander agree. The United States is a relatively closed economy. Are we an economy of fiscal stimulus, thinking of refunding and all the other debates, versus Europe in austerity stimulus? I mean, are we living a fiscal stimulus that makes us different?
Well, yeah. Well, I mean, we, as Chris says, as Steve says, we're a sort of closed economy. We don't have to worry necessarily about what's happening in Europe as much as Europe has to worry about what's happening in the United States and China, their biggest trading partner. And so we can stimulate the economy and we can run deficits for a lot longer. Nobody knows exactly how high or how long, but it doesn't have the same kind of effect. Interesting to note where we are with yields these days is where we were in the 1990s when we were growing at 4.5% a year. So can we live with this? I mean, for now, we can.
Right. Stephen Stanley with us. So I'm not going to go higher for longer, but just pick one of them. Are we going to go higher or are we going to go longer?
Well, I think the more important thing is the longer part. They may go one more time, but we're pretty close to the end. So I don't think the higher part is the more important of the two right now. I think the more important issue is how long are they going to stay
Can the American economy equilibrate through a higher nominal and real rate? Or almost equicalibrate, I would almost say.
Yes, I think we're in the process of that. I think that in my mind, the neutral rate is anywhere from 50 to 100 basis points higher than it was before COVID.
So give me a 10-year real rate, which is going to be a run rate.
I think it's probably 1 to 1.5%, something like that.
Okay.
When we look right now at the data that we're getting this week, you said that the Fed seems to be looking for an excuse, and it's not really that they're so concerned about what you call this little backup in yields. So what data could make it difficult for them to use the backup in yields as some sort of an excuse?
Well, boy, we're really testing that, right? Because since the September meeting, we've had a blowout payroll number, a high inflation number, stronger than expected consumer spending, and now we get a firm wage number. So you're pretty much a clean sweep, and yet they're clearly going to pause. So I think it's going to have to be not so much a particular data point, but a duration of a stretch of good data. If we continue to see good data for another month or two, then, I mean, it just becomes increasingly compelling.
So tomorrow, based on what they say, and based on the economic data, what are the chances, from your view, that they've got to go significantly further than currently markets are pricing?
Yeah, so significantly further is a really important part of that question. Because as I said, I mean, my base case, I have one more hike, but that's, I mean, whether they do one more or not, it's not that important. But there is a scenario where inflation reaccelerates and they end up having to go multiple times. I think that's the scenario that you might have in mind. I mean, to me, that's the biggest risk factor. I see that as a bigger risk than the risk that the economy slides into recession and they end up easing much sooner than people expect. But it's at this point, for me, it's a risk scenario, not a base case.
Is it true you're going for Halloween? You're going as dot plot?
That's a rumor. I can't confirm or deny that.
You had Bullard up at the tippy top of your head?
There you go.
Okay.
I have a lot of room on my head for dots.
So do some of us. Well, also John Farrell going as Yul Brynner. I don't know if you knew that. One of the Magnificent Seven.
I look forward to seeing that
costume. Good to hear
costume.
from you, John. It was good to hear. Stephen Stanley with his chief U.S. economist at Santander, and just outstanding on American economy. We got to get him back to talk about 5% GDP and all that. What do you think of the markets here? They come in a little bit off the McKee's gloomy eco benefits, wages, and all that.
It highlights the nervousness, the fact that the NASDAQ has now turned slightly negative, the fact that suddenly, again, good news is bad news. If, higher wages is good news for everybody, the rank and file, but we're looking at a scenario that Stephen Stanley laid out really well, which is that the risk of reacceleration is greater than the risk of recession.
Red and green on the screen. NASDAQ a little bit red here. Standard & Poor's 500 up 5 points right now. I'm going to call that 0.1%.
Michael McKee's still here with us, parsing through the data, understanding the sort of machinations behind it. How durable, how sticky are some of these employment costs that are going up, leading to, yes, higher wages, but also perhaps margin compression and basically margin compression.
Well, they've been relatively sticky because there's almost no change in the quarter-over-quarter numbers. The wages and salaries overall up 1.2%. That's an acceleration from 1% before in the second quarter, and then in the private industry, 1.1% after 1%. So we're still seeing wages go up at a little bit faster pace. Benefits go down a little bit in cost, but part of that is timing. But the point is we are seeing sticky wages at this point. And it'll be interesting to see what happens with hourly earnings on Friday.
November 1, a Fed meeting. Jerome Powell's going to have to be saintly, to say the least. What does he not want to say in your press conference?
Well, he definitely doesn't want to say recession, and he doesn't want to give the idea that inflation is going to accelerate. He wants to be on the progress bandwagon. But I think the biggest message he wants to leave people with is that the Fed might be done, but we're not going to say that because we don't want the markets to price that sort of thing in.
Michael McKee leading our coverage tomorrow on the Fed. Again, the former Vice Chairman, Richard Clarida, will be with us as well. Lisa, red and green on the screen. I mean, that's all there is.
The fact that good news is still bad news tells you everything you need to know. And it's been on the margins. It's not a massive move yet, but just wait. We get the consumer sentiment survey coming out later, right? I believe at 10 a.m. And housing data coming up on the open. Kathy Jones of Charles Schwab, Troy Gajewski of FS Investments, and Aaron Brown of PIMCO ahead of that key Fed meeting, but also the Treasury refinancing agreement, which might be actually more important.
All over that.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We know there's a lot more that needs to be done, but it's because of American leadership on the ground and American convening power that we're able to get that aid in and try to see if we can sustain it. We're working very hard at this. I just want to repeat it. Every single innocent life lost is a tragedy. Every one, whether it's a Palestinian life lost or an Israeli life lost. Every one should be prevented.
John Kirby at the White House, the National Security Council spokesperson, but far more Admiral Kirby, who understands how ships sitting in the Eastern Mediterranean are at risk. We say good morning to all of you. Bloomberg Surveillance from New York. John Farrell on assignment. Lisa Bramowitz getting ready for the 9 o'clock hour here off of ECI, and the markets pulled back a little bit. A Fed meeting tomorrow. Apple earnings the next day off of the announcement we saw last night from Apple, their marketing campaign on new products as well. We're also considering, well, a data check here, and I'm going to go to oil right now, 88.02, quiescent, given the tragedy that we see in the Eastern Mediterranean. This should be a 2-hour conversation. I can't say enough about the work of Dr. Miller. He is Aaron David Miller. He's a senior fellow of the Carnegie Endowment for International Peace. The shingle is from the University of Michigan, Definitive in International Relations. And he wrote a book in 2008 that was shockingly prescient 15 years on about the mess we're in in the Eastern Mediterranean. Aaron David Miller, thank you so much for joining us this morning. When you wrote your masterpiece in 2008, did you expect the tragedy we're living now?
I expected, John, that an unresolved Israeli-Palestinian conflict driven by a proximity problem. Israelis and Palestinians are living on top of one another, and frankly, I think it was Mark Twain who said that proximity breeds contempt and children. I figured that this conflict would endure. It would go through periods of accommodation, perhaps, as it did, but also periods of conflict that we've seen. But I think, I for one, I'll put myself at the top of the list, never anticipated the kind of trigger to this particular phase of the Israeli-Palestinian conflict. That is to say, what happened on October 7 with Hamas's brutal and savage attack and its willful and intentional indiscriminate murder of men, women, and children. I did not anticipate that, and clearly in probably one of the two greatest intelligence failures in the history of the state of Israel, neither did the Israelis.
Aaron David Miller, Robert Gates writes a piercing essay in the New Foreign Affairs magazine. I read every word of it, the former defense secretary and head of CIA, on a dysfunctional America, a dysfunctional superpower. You are someone that straddled the line, I would say, within the politics of Washington. What's Aaron David Miller's best practice now for the Biden administration?
When it comes to this particular crisis, remember, we now have an arc of crisis. We have a major crisis in the Middle East with the potential of escalating even further. If you end up with an Israeli-Hezbollah war, you're going to see, not to mention the prospects of Iranian involvement and direct confrontation between Israel and Iran, which would lead to spiking oil prices and plunging financial markets and even more uncertainty with respect to the global economy. You've got Russia's invasion of Ukraine. You've got tensions in the Indo-Pacific. Look, I've long believed, I'm a follower of Reinhold Niebuhr, proximate solutions to insoluble problems. This is a world that cannot be resolved. That is to say, I'm not sure there is one conflict out there you could identify that had a definitive or comprehensive solution. This is all about smart management and a judicious and very balanced view of the projection of American power in areas that, in fact, we can and affect. But no, this is not a world to be redeemed or resolved. Right. It's one to be managed if we're lucky and smart.
Aaron David Miller, Robert Kaplan's new book, The Loom of Time, is my book of the year. It's just a sprawling treatise from Morocco all the way over to Persia, indeed on to Afghanistan as well. And what permeates Kaplan's realpolitik is the basic idea that we have a human rights-led foreign policy. Is our human rights-led foreign policy at risk, given what we see in the Eastern Mediterranean region?
You know, Kaplan's a really smart guy. Based on my experience, John, working for Republicans and Democrats over a 30-year period from Jimmy Carter to Bush 43, I don't think we have a human rights-based policy. In fact, human rights, democracy, promotion, responsibility to protect, intervention to prevent or even respond to mass killings, from the Holocaust to Cambodia to Rwanda to Darfur to South Sudan to Syria. Where has the United States been with respect to the protection of human rights? I'm not saying that is a role we need to play and can play all the time, but I think human rights is a factor. But based on my experience from Carter to Bush 43, it's rarely at the top of our agenda.
There's been shades of isolationism there, even off of the shock of Jimmy Carter and the Iranian hostage crisis in, I believe, 79. What does our new isolationism look like?
I'm not sure. Well, clearly, we're not there now. I mean, I think the America First notion, although I think that largely would translate into putting America last, we've got to find the right balance, John, between doing too much in the world and not doing enough. One of my former bosses, Madeleine Albright, referred to the United States as the indispensable power, you know, and I remember what de Gaulle said about the cemeteries of France. They're filled with indispensable people. We can't be the indispensable power if indispensability means that we need to be everywhere to everyone all the time. We have a dysfunctional political system. That's the strength, by the way. Repairing that is critically important to our capacity to lead, not by the, what Joe Biden says, not by the example of our power, but by the power of our example. There is something to that.
From where you sit in international relations, is our Pentagon properly funded, and specifically, does the Navy have enough ships and submarines?
Probably no and no. I suspect, even though there are some who argue that our defense budget is way out of whack. It'll be fascinating to try to see how we're going to resource going forward, because each of these problems I referred to, what you're seeing in the Middle East right now, Russia's war against Ukraine, which seems to be forever, and the prospects of a rising China in the Indo-Pacific, all of these things have to be properly resourced. And that's a concern that I have, given the nature of our domestic politics.
One final question, Aaron, to circle back to your 2008 treaties. There is a much to promised land. What should we advocate to Israel and the Palestinians in this November?
You know, a lot of people I respect, John, believe that the so-called two-state solution has gone the way of the dodo. I understand the argument, but frankly, it's the least bad solution to this conflict. Israelis and Palestinians need to separate from one another through negotiations. There's no precedent that I can think of two national movements, one a state, a non-state actor seeking to become a movement, living happily ever after under one roof. It's Cyprus, Lebanon, Syria, Iraq. I mean, the beat goes on. So it's just a hop, skip, and a jump to understanding that if, in fact, you can have anything resembling a conflict-ending solution, I'm choosing my words very carefully here, you really do need to have separation through negotiation, maybe into a confederation at some point, but you need to satisfy the political, territorial, emotional, psychological, and religious underpinnings of this conflict. The only thing that does that, in my judgment, is to separate through negotiation, state of Israel living peacefully next door to a Palestinian polity. That, to me, is the only way to even begin to think about fixing this.
Aaron David Miller, thank you so much for the brief. Hugely valuable with the Carnegie Endowment for International Peace. And I really can't say enough, folks, about the overview there from Dr. Miller versus the immediacy that we see from Oliver Crook in Tel Aviv and our Anne-Marie Horton in Washington as well. Again, look tonight to balance of power as we go into a difficult Eastern Mediterranean evening. Tomorrow at 1:30 p.m., Bloomberg Surveillance. It is our special, The Fed Decides. Honored to have Richard Clarida with us with his perspective. Honored to have Jerome Powell with us at timely press conference as well. Michael McKee leading our coverage. Futures up 7, green on the screen, VIX 19.39. This is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A bit of a range-bound market as people parse through good news. Is it bad news with the Fed on deck tomorrow? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
Futures steady as stocks close out the worst October in 5 years. The Fed kicking off its two-day policy meeting, and the Bank of Japan allowing yields to climb above 1%. We begin with the big issue. Here comes the Fed.
The Fed is going to hold
the course.
We'll have a more hawkish hold.
A very hawkish tone, but a pause.
I think it's pretty much consensus.
We're not expecting a surprise.
High for long will still be an important part of the narrative.
Beating that drum of higher for longer.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
The continued strength of the economy actually handcuffs the Fed.
The economic data in the U.S. has been quite resilient.
The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
It's an extremely tight labor market.
The Fed is looking at all of these data juxtaposed with inflation that's still too high.
The Fed is probably going to want to keep its options open.
How are you doing today? I'm going to place order to sell short euro. The price I'm looking to sell at 106.37.5. Okay, I'm going to place an order at 106.37.5. Excuse me. And as soon as we will get filled, I will let you know what's going to happen next, when we're going to place stop loss. You still have time, so if you want to trade with me and make a profit on trading euro against United States dollar, I will not put red color yet, because we just placed an order. For some people who knows, who've been following me for quite a while, they will understand that if just white line or yellow line, it means that we didn't fill yet this order. So they will understand that they can place an order. What I wanted to say, if you want to place order, it's time. So you're welcome to place an order and wait for me until we will fill this order, and then I'll speak to you later. Okay, guys? Stay safe.
Rather entertaining to watch markets price in aggressive cuts
through this year, not only next year. And obviously they've gotten a substantial bear steepener. They've gotten multiple compression, a little bit of spread widening. So financial market conditions have tightened substantially. So they do have the room to sit back now and not be overly aggressive. And, we agree with Kathy, they're more than likely done. That being said, if inflation picks back up as it has recently, at least they have the flexibility to hike.
Yeah.
Until then, they're going to follow the data.
The news you need to know. Data dependency is data dependency at this point in the stage. There is a question, Kathy, and I joke because it's true. At this time, maybe they actually mean it. But the data we got out just about a half an hour ago really has to do, Kathy, with employment costs going up more than people had expected. How much does that raise your concern and make you question your base case that the Fed has done?
Yeah, I think the ECI is important. We know the Fed follows it. It is, if you parse the data, and I only had a few minutes to look at it in detail, but it looks like the biggest wage gains continue to be in professional services, insurance, finance, et cetera. And actually, some of the key service sector areas like leisure and hospitality, the wage gains were lower, notably lower than they have been for a while. So I think the overall trend is in the right direction. I don't anticipate at this stage of the cycle, given everything that's going on with the layoffs that we're hearing about and the job postings coming down, that we'll start to see some surge in wages. So I don't think that's going to change the narrative or the direction of the Fed at this stage of the game, but it can prolong the cycle simply because the Fed will be on hold for longer as we go into 2024.
Troy, I'm curious from your vantage point how much stocks are still in the clutches of bond market volatility that has far outpaced anything we've seen in the equity space.
Yeah, bond market volatility, fixed income volatility in general has been off the charts this cycle. The back end of the curve is definitely driving multiples in the short term or valuations in equities. If we get further bear steepening, there's almost no doubt that we'll compress by a half to another turn. But then, of course, in the background, and this is one of the reasons the Fed probably should not hike further, is they continue to drain the balance sheet really close to target. Money supply continues to shrink. So, sit back, let inflation gradually cool, understand that there's going to be fits and starts, but don't be overly aggressive and cause another market accident.
Sit back, relax, and enjoy the central banks. There are a lot of central banks in focus this week. The Bank of Japan loosening its grip on bond yields with policy decisions from the Fed and Bank of England still to come. Joining us now is Bloomberg's Michael McKee. Some interesting developments overnight heading into all the drama.
Yeah, absolutely. In Japan, the Bank of Japan did as was leaked prior to the meeting and tweaked their yield curve control program, but it's more of a tweak than perhaps people anticipated. Bank of Japan loosening its cap, no longer setting a cap. 1% is now the reference rate rather than the cap level. So the market could push, and you can see in the overnight index swaps there, the market is pushing the yield higher than 1%. Those red dots on the white line are where the Bank of Japan has changed its yield curve control policies. And you had asked Troy about whether the bank is letting the markets dictate. The markets are dictating in Japan, and they pretty much have to now with inflation where it is. In the U.S., we did get the ECI number, not really going to affect the Fed. And you can see over on the left-hand side, completely flat for November. The markets do not think the Fed will raise rates. There's still a little bit of a chance of another rate rise priced in for the next couple of meetings, but then the market still thinks we're going to see big cuts next year from the Fed. Will that change after tomorrow's meeting? And then, of course, the final question for everybody here today is the Bank of China, People's Bank of China. A lot of people hadn't focused on that. Xi of the Bloomberg MLive group put this chart out. This is something to watch. The Chinese yuan volatility rate, the fixing rate, has dropped to 0. And look at how it has moved between 2015, when they revalued the yuan, and today. So if they have essentially repegged to the dollar, then they're going to want to buy treasuries in order to keep that peg. And they, according to Brad Setzer at CFR, they have the money to do that. and they could do that. So it looks like the Chinese may be setting up for a new regime. We'll keep an eye on that. And that's one central bank thing, Lisa, that a lot of people haven't focused on yet.
Michael McKee, fascinating. Thank you so much. There's a larger question here that kind of raises, which is how much are the cross-border flows mattering more than some of the economic indicators that we keep clutching to? Kathy Jones and Troy Gajewski are still with us. And Kathy, I'm curious from your vantage point, how much the refunding announcement that we're going to get from the U.S. Treasury Department tomorrow, that the idea of the Bank of Japan potentially allowing investors to stay in that country rather than going to the U.S. for yield, how much those dynamics are taking precedence over economic ones?
Yeah, I've been pushing back against the narrative about Treasury supply being a major driver. Not that it doesn't matter, it does matter, but in this environment, I think what's been the big driver has really been the surprising performance of the economy. So if you look at the Citigroup, surprise index, economic surprise index, you plot that against 10-year yields over the last 6 months, you see a pretty strong correlation. I think that was probably the main driver. Supply usually isn't the big driver. It's usually not a big surprise. And keep in mind, even with Japanese nominal rates rising, real rates are coming down because their inflation's picking up, while our real yields have been high and staying high, and probably will rise even further, even if the Fed doesn't do anything, because inflation is coming down. So I think there's a lot of constellation of factors that have driven yields higher. But I think at the end of the day, the big thing is, what's inflation doing, what's economic growth doing, and what's the Fed doing? Those are probably the key factors to watch. And the rest of this is just a lot of extra input right now and keeping volatility high.
Troy, do you agree with that?
Yeah, well, look, I mean, there's plenty of good fundamental reasons why we're in a higher for longer regime, and we've had a very stronger economic growth, more persistent inflation, a Fed that's not cutting anytime soon, despite what the forward markets are pricing in. But the technicals do matter at times. And, right now in particular, when you have the largest buyer in history, the Fed, being the largest seller in history, you have a banking industry that's really cautious about stepping in as rates go up because of all the book value destruction. And you just don't have as much foreign demand as we did, say 5-10 years ago. The technicals arguably matter more now than, say, 6-12 months ago or 3 to 5 years. But certainly at the end of the day, inflation expectations, inflation, strength of the economy tends to drive the show in the yield curve.
Do you think that, Troy, there is a susceptibility right now, based on market positioning, to a massive short squeeze within the Treasury market, just based on how volatile things have gotten and the fact that more people are suddenly throwing out 6%, 7%? I mean, there has been a real bearishness embedded into a lot of market positions.
Yeah, no, it's a great observation. I mean, it's very similar to equity markets, right? And equity markets don't go down in a straight line. They don't go up in a straight line. We had substantial multiple compression, very strong rally. You look at the 10-year this cycle, we got to 3.25, rallied back. That's it. The Fed's done. Got up to 4.25, rallied back. Now we touched 5. We are in the middle of a relief rally, partially driven by positioning. And to your point, liquid markets tend to swing back and forth between, panic and fear. And a lot of the prognosticators that were very confident that the Fed was going to cut soon are now calling for 5.5 or higher 10-year yields, which could happen certainly with this fundamental technical picture. But a flat yield curve, 5.25, 5.5 makes a lot more sense than a 6 or 6.5% 10-year right now.
Kathy Jones, Troy Gajewski, both of you are sticking with us. And Kathy, I will let you get a final word on that coming up. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle.
Well, Lisa, let's take a look at two stocks that are dragging, one that is helping out the major indexes. Starting out with the shares of Caterpillar, they are down despite a very solid profit beat. What investors don't like is the fact that its order backlog decreased $2.6 billion from the second quarter. That stock down 6% in the pre-market. Sarepta Therapeutics absolutely plunging down 43%. If these losses hold, it will be the worst day since 2021, and this as a gene therapy, a trial with Roche for Duchenne muscular dystrophy failed the primary endpoint. And then to the upside, Pinterest up 15%. Investors and analysts very encouraged by the fact that there was solid profit margin and that revenues grew, Lisa.
Thank you so much, Abigail. Coming up, the Fed taking a back seat to the Treasury's new borrowing plans.
The Fed basically has outsourced monetary policy to the Treasury. I mean, we have the bond market, doing a lot of the heavy lifting.
I guess we can call it a Super Wednesday that's on deck with Chair Powell and the Treasury Department at the fore. That conversation coming up next.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
The Fed basically has outsourced monetary policy to the Treasury. I mean, we have the bond market, doing a lot of the heavy lifting. Term premium has risen, and its backup in long-term rates is one of the reasons why the Fed probably will skip hiking this meeting. We do get a bigger supply announcement than what the markets are expecting, and markets are really fearful of who's going to take down all this paper into year-end when balance sheets are getting very precious.
Wall Street isn't just focused on Wednesday's Fed decision. The Treasury's refunding announcement taking center stage thanks to a recent run-up in yields. Traders broadly expecting a record $114 billion in refunding. The plan could see auction sizes increased for all but the longest debt, as the federal deficit is expected to climb above $2 trillion in fiscal 2025. Meanwhile, the Treasury reducing its estimate for federal borrowing this quarter, easing some deficit-related concerns. Joining us now, I'm so pleased to say, Bloomberg's Kaylee Lyons. Kaylee, I want to start just with where people are thinking the Treasury is going to come out tomorrow with this announcement in terms of just how much money needs to get borrowed through the Treasury market.
Well, as you said, Lisa, $114 billion for next week's sales of threes, tens, and 30s is what is anticipated. But tomorrow really is going to give us that finalized picture of what supply is going to be looking like, knowing that the Treasury has had to issue a lot more debt because the deficit is rising. Already in the year through September, $1.56 trillion of bills on net have been sold the year through September. So this really is what the bond market is bracing for. Now, of course, against the backdrop of yesterday's announcement from the Treasury that $776 billion is their new quarterly borrowing estimate for this period. That's down from about $852 billion. Primarily that cut driven by higher than expected revenue projections because of deferred receipts from states like California and others where they've had natural disasters and were granted extensions. But still, despite the reduction in that borrowing estimate, the new projection still marks a record amount for the calendar fourth quarter. And of course, as the bond market considers what the Treasury is going to do here, it's as we see 10-year yields just off of that 5% level we reached earlier this month, still hovering around the highest we've seen going back to 2007. And of course, what's interesting is Treasury Secretary Janet Yellen was here at the Bloomberg Bureau in Washington just last week, Lisa. She was asked about the moves we have seen in the bond market, and she thinks the higher yields are reflective not of the higher federal deficit, but instead of strong U.S. growth and rates that are going to have to stay higher for longer. But of course, not all market participants are agreed with her on that.
Kayleigh, just quickly here, I'm wondering how much this is what's hanging over the discussion about fiscal support behind some of the conflicts that the U.S. is getting more and more involved in, including Ukraine as well as Israel.
It very much is for the Republican Party, Lisa. A lot of conservatives would like to see more fiscal discipline exercised here in the U.S. And, of course, on the case of Israel funding, which the White House has requested about $14 billion from Congress, the House Republicans unveiled a bill just yesterday that would effectively offset that by cutting more than $14 billion in funding from the IRS. That's not something we usually see with emergency funding requests, but it speaks to the idea that that party would really like to see this deficit brought under more control.
Kayleigh, thank you so much. We have been talking about that with our panel, who still is here, Kathy Jones and Troy Gajewski. Kathy, I know we were talking about how you've been pushing back against the sort of deficit questions around the bond market, but there is larger uncertainty kind of hanging over the market. Do you think that there is a lesson to be taken away? The treasuries no longer are the havens that they once were during times of uncertainty and conflict.
Well, I think that's a big step to take from here. And so, you buy U.S. Treasuries, you're still going to get your principal back at par and your interest, and that's not true in a lot of other asset classes. And keep in mind that global yields have risen, even though deficits haven't risen everywhere else. So you have to explain this in the context of, yes, deficits are up. The price-insensitive buyer, the Fed, is not there. And so there's more funding to be done. But that isn't, and in my book, that's not the main driver of why yields are up. And as we go forward, clearly we have to finance the deficits, and higher yields will help do that. So right now, although we've seen a lot of shifting around in the composition of buying, households have been huge buyers of treasuries, more than happy to take down a lot of treasuries in the 5% region. So it's more a question of where's the equilibrium, right? And I think the equilibrium is probably roughly around that 5.25% area.
How much, Troy, do you sort of look toward new havens at a time of uncertainty? Kathy's challenging that, and a lot of people do. But still, there is a conversation. Is it Apple? Is it Microsoft? Is it gold?
Yeah, I mean, look, treasuries are still treasuries. So we're with Kathy on that. And to her point, the biggest asset allocation rotation this cycle has been to cash and T-bills, period. Right. But one of the things as an investor you should try to do now is look for other exposures that can at least marginally produce higher return. And, one of the beauties of this bear steepener is it's taken the ability to refinance on mortgages even further out of the money. So that continues to be one of our favorite ways to play higher rates is prepayment sensitive RMBS. You have government guarantee, both implicit, explicit. You have tremendous yield. Interest-only strips hedged with pass-throughs have close to 14% yield, and you don't have the duration risk that could come from further bear steepening. So cash has been king this cycle. We like to say cash flows even better, and you have really attractive cash flows in agency RMBS relative to history and relative to the risk of prepayment in this environment.
Kathy, are you going into more esoteric instruments, or are you looking to just focusing? I'm not saying that that's esoteric, but I'm just saying, do you have to diverge much beyond long duration treasuries at a time where there is potential that people keep highlighting of pretty significant gains should yields come back down?
Yeah, I agree with Troy on the agency MBS. I think it's a great opportunity for a lot of people, and we're seeing a fair amount of interest in it. We like investment-grade corporates as well. That yield curve is flat to upward sloping, which means you can get 6 to 6.5% in relatively moderate duration of 5 to 7 years, and you're not penalized for a little bit more duration. So it enables you to kind of extend that window of cash flows into the future with a much bigger cushion than you might have, say, in Treasuries. So we're not going into low credit quality. I'd say that's the one place that we're being cautious, whether it's high yield, bank loans, et cetera. That's the area, depending on how the economy plays out. We just don't think the risk reward is that attractive. When you can get 5 to 6.5% in high quality bonds, why should you take that extra risk to get a little bit more?
Do you agree with that, Troy, sort of staying away from the lower rated credit?
Yeah, I think you really want to avoid the levered loan market in particular, just given that debt service coverage ratios have gone lower. You've also had a steady deterioration of credit quality. So if you're going to do something that's credit sensitive, make sure it's backed by a tangible asset. You know, performing real estate properties would be an example, or it's a newer vintage middle market lending area where you're lending after base rates have already come up, after LTVs have dropped. So you don't have as much credit risk for newer vintage middle market loans as you do, say, in, you know, legacy levered loans or, you know, older vintages in the middle market. You just have more credit risk because of how much interest expense has gone up, and you always have some degree of economic sensitivity.
Kathy Jones, Troy Gajewski, both of you, thank you so much. Coming up, the morning calls. And later, PIMCO's Aaron Brown joining us at the opening bell, looking ahead to the Fed and a busy stretch of earnings. That conversation still ahead.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
To the open, I'm Lisa Abramowitz in for Jonathan Farrow, taking a look at markets ahead of the open. The Nasdaq solidly negative after a better than expected economic print. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, North Coast Research upgrading Boeing to buy, citing the plane maker's promising long-term earnings potential. Next up, MoffettNathanson downgrading Lyft to sell with a street low $7 price target, expecting a notable decline in Q4 bookings and margins. And finally, JP Morgan upgrading AutoNation to neutral, seeing a more balanced risk-reward after recent declines on the heels of potential questions around the resilience of
Okay, guys, hello again. It went to, as you can see, far from our order. So let's cancel it. Let's see when it will be another opportunity to trade euro. Okay, in the meantime, please cancel your order and stay with me. I'll speak to you later, guys.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, just moments away from the start of trading, and you can see a pretty boring market out there as we try to find some sort of direction. S&P futures still clinging on to some gains. NASDAQ basically flat. What we're seeing outside of stocks really might be what's driving this. We have seen a retracement in the increase in yields. We are seeing yields lower, but not by much. They were lower by much more earlier. Euro losing some versus the dollar after showing disinflation, but also a potential recessionary condition in crude just a little bit elevated. One stock to watch at the open is Caterpillar, the company reporting shrinking backlog, signaling demand worries. The CEO saying, quote, we remain focused on supporting our customers' success and executing our strategy for long-term profitable growth. Abigail Doolittle has more. Abby.
Well, clearly investors not liking this, Lisa, with the stock down about 6%. Its worst day since April of 2022, and it has everything to do with that shrinking backlog. Now, the quarter that they reported on the surface, not so shabby. There was a 15%, nearly 16% profit beat. They put up $5.52 in adjusted earnings. Revenues basically in line, nearly $16 billion. So we're not talking about small numbers, but relative to the backlog, there was a year-over-year decline of $1.9 billion. That is the first since the third quarter of 2020, when it really had to do with pandemic supply issues and the like. So this is a bit of an outlier. And we also have Baird saying that some of the dealer inventories, well, they're continuing to grow, which essentially means that they're not going to have to order as much, showing up in the backlog. Investors nervous that this could continue. This stock now, Lisa, underperforming the S&P 500 somewhat dramatically on the year. That index up closer to 10%. Caterpillar now down about 5% on the year. And again, investors really not liking this quarter at all as the stock continues to slide. Right now at session lows, down about 6.5%. And that is still, I'm waiting for it to come up, that is still at one point, it was the worst day since November of 2020. So we're off of those lows, but the worst day since April of 2022.
Abby, thank you so much. Turning now to the airlines, JetBlue reporting a bigger than expected loss due to poor weather and air traffic control issues. The CEO saying, quote, we're making improvements to drive profitable growth and ensure JetBlue is positioned for success in 2024 and beyond. Isabel Lee has more. Isabel.
Hey, Lisa, the stock is now tumbling almost 13%, and the adjusted loss will be 35 to 55 cents a share. That's much higher than the 25-cent deficit projected by analysts. Revenue will decline up to 10.5% from 2022, also missing expectations. So for JetBlue, they're banking on international travels for their growth in the next quarter. So this just really shows that some U.S. carriers have been hit harder than others. But overall, the industry is just in general grappling with the waning demand, aircraft delivery delays, and parts parts shortages. And this also comes in the middle of a crackdown on airline consolidation this week, in which the U.S. Justice Department claims that JetBlue's bid for Spirit would limit flight operations. For now, Lisa, shares are tumbling almost 12%, and JetBlue is down around 35% this year.
Isabel, thank you so much. Sticking with earnings, Pinterest jumping on expanding margins and strengthening growth rate. The CEO saying, quote, "We're finding our best product market fit in years. Our users are engaging deeply, and we're delivering better results for advertisers. Evidently, everyone is planning parties and decorating their homes." Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. The stock up almost 14% as it stands on track intraday for its biggest jump since October of last year, 2022. At the open, it was on track for its biggest jump since August of 2022. They're talking about making the platform more shoppable, the investments that they've made in artificial intelligence, driving the user base to make purchases in the e-commerce context based on the images that they're looking at. A beat on the top and bottom line, revenues coming in at $763.2 million, ahead of estimates. Adjusted EPS 28 cents per share. The estimate was for 20 cents. What's most interesting is the monthly active user base. 482 million users, monthly active users, is a record and eclipses the pandemic peak. But then within that is the growth narrative, and that growth is coming from ROW, those markets outside of the United States, Canada, and Europe, which makes up more than 50% of the user base. So they're seeing traction in the rest of the world region, and what they're talking about here is that investment in AI being a key factor in helping them pay off. The stock up 13.5% as it stands.
AI decorated rooms. Thank you so much. Another story in the retail sector. VF Corp falling after the footwear company withdrew guidance for the fiscal year. The CEO saying, quote, "Our transformation plan will improve our brand building and execution while addressing with urgency our top priorities." Such corporate speak this morning. Katie Greifeld, who is by Halloween pair today in orange to my black. What's going on?
It has been a brutal showing for VF Corp. Like you said, shares down about 4% right now after pulling their guidance, introducing that turnaround plan. It's really aimed to cut costs, reduce debt, and really overhaul that Vans footwear brand, where in that specific unit, revenue dropped 21% in the fiscal second quarter, and the company warned that performance isn't expected to improve in the fiscal second half. Now, as a result, they're reshuffling the C-suite as well. Vans president Kevin Bailey going to step down. CEO Bracken Darrell will lead the unit in the interim while they search for a replacement. And of course, all of this comes while you have two activist groups circling the company. So even with these overhaul plans, Wall Street still sees a really tough road ahead. After the numbers this morning, at least 3 banks cut their price targets, 1 downgrade coming from Williams Trading, 2 hold from buy. Shares currently off about 3%. They had been down more than 10% in the pre-market, so some of that loss coming back. But VF Corp shares down by more than 40% year to date, Lisa.
Thank you so much, Katie. Meanwhile, stocks heading for an 8th year of outperformance in a decade. Goldman Sachs believes and that it's kind of running out?
I actually disagree with that statement. I mean, you've seen a decade of U.S. outperformance, but I think that's been really justified by the fact that the U.S. is a higher quality index. It has higher free cash flow generation than its European or other developed market non-U.S. peers. And in addition to that, in a market where you're getting, 5-6% yield on cash right now, cash-rich U.S. companies stand to benefit from being able to invest that cash into, decent yielding environments. So I think that the preference for quality, particularly in this type of cyclical environment, is going to continue to outperform. And I think that the U.S. is best positioned on a regional basis to take advantage of that.
There are a couple of questions embedded within this. Number one is how long can the U.S. ride its tech wave, right? And that's been a big question. There's also this question of whether the U.S. can get disinflation without incurring some more economic pain. Can we start on the latter to begin with? Do you think that that is possible to get that disinflation that the Fed is seeking without seeing the kind of pain in the likes of Europe and elsewhere that's transpiring?
So you are starting to see inflation come down. I think the question really is it going to come down fast enough and far enough in order for the Fed to meet its objective of 2%. I think that you'll likely see, it's probably a safe bet that you'll likely see additional financial condition tightening, at the end of this year and through next year, whether that's through markets itself or through the Fed doing one more interest rate hike. And I do think that that will get inflation down, but it's probably going to still remain sort of sticky in a high 2% range through the end of next year, which is, I think, going to be difficult for the Fed to really engineer any type of accommodation with interest rate cuts. So I do think it's a fairly fine line that the Fed is going to be facing next year. But ultimately, we are seeing inflation come down. I don't think you're going to see significant economic pain in the U.S. You may see some retrenchment. So I think you're going to see real differentiation emerge as we move through 2024. You saw some of that this year, and I think you're going to continue to see it next year in terms of differentiation between the high-quality stocks and their lower-quality stocks. Right now, stocks are competing against a yield-rich environment on the fixed income side, which is, yielding you, north of 5% on cash. And so that's a difficult environment for equity investors as a starting point. So, for companies that aren't delivering with respect to earnings, with respect to sales, and with respect to free cash flow, there's another alternative out there right now on the fixed income side, and it's a safe haven asset. That said, I think that high-quality companies that are able to generate growth and free cash flow will, continue to do well in 2024, because I don't think we're going into, a recession. And if we do go into a recession, it's going to be, a fairly mild one. And so in that environment where you have, slow growth, but not necessarily severely negative growth, stocks that are able to generate, good returns, good earnings are going to continue to do well. So I think, you really have to pick your spots as you enter next year.
As you pick your spots, and it is selective, I'm curious how you're allocating, given the fact that the ballast of bonds has shifted and that the ballast of stocks has become more idiosyncratic.
So I think that, particularly good quality, high, investment grade fixed income instruments, I think should continue to do well. Agency mortgages, I think, look very cheap. Even non-agency mortgages, structured products also look, relatively attractive in this environment, as does high quality fixed income broadly. Some equities, I think, also look attractive, but where we're really staying away from are equities that are really dependent on a easy interest rate environment. Some stocks like the home builders, like consumer autos, have done really, decently well this year, particularly the home building sector. But yet, an 8% mortgage rate is going to really start to bite next year. And so I think that those are the stocks, the ones that are consumer facing, but also highly dependent on easy credit. Those are the stocks that I think that are underperform. Broadly speaking, I think the equity market will have sort of low, sort of to flat growth next year in terms of the total equity return. But I think you will see real differentiation between, those stocks that can internally generate its own growth and cash flow versus those that are really dependent on an easy financing condition, which are going to be hurt, I think, even more so next year.
Within the credit sphere, you're talking about some of the more interest rate sensitive on the equity sphere. In the credit sphere, there's been a lot of befuddlement about why we haven't seen more pain. Former Fed Governor Jeremy Stein was quoted in a Bloomberg piece today saying, if you had told me 2 years ago that the Fed would hike by this much in a short time, I would have said that they would leave dead bodies littered across the corporate credit landscape. A lot of people would have agreed. Is that deferred, delayed, or just put off indefinitely?
I think it's a little bit of both. I think, firstly, you've been in an environment with over a decade of super low interest rates where corporates have termed out their debt. And so you haven't seen, significant debt maturities coming due over the last couple of years. And I think as a result of that, companies have been able to hold in there. If you look at interest rate costs in the U.S., they haven't, increased in terms of the aggregate share of the corporate balance sheet that much. And corporates that are cash rich have actually been able to take advantage of this high interest rate environment and reinvest their cash flow into higher yielding money market funds or cash funds. And so as a result of that, you haven't seen corporate credit pain. You also haven't seen household pain either, because similarly, households have been able to term out their debt structure through the 30-year mortgage, which is why you're seeing a different outcome in the U.S. with respect to non-performing loans versus other more interest rate sensitive economies. That said, there's only so long that this can last. And so you are seeing cracks in the levered loan market. You are starting to see some cracks in the floating rate market, as well as the more distressed high yield market. I think that those are going to be more idiosyncratic stories. We don't have a significant debt maturity wall until the end of this decade. And so I think by and large, corporates that are investment grade should hold in and be okay.
Erin Brown, thank you so much, as always, for your insights. Coming up, Apple unveiling new products ahead of Thursday's results.
The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened.
Can Apple earnings help big tech get its mojo back? That conversation coming up next.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened. I'd be very interested to see how the Apple numbers are received. I suggest again there will be a proneness among investors to look for the holes, look for the cracks, look for any weakness, simply because the Magnificent Seven have been priced for perfection.
Tech results continuing to roll out with Apple in focus ahead of its Q3 earnings report. That comes out on Thursday. The company unveiling a new iMac laptop and third generation of its in-house processor line at its Scary Fast event last night, which is fantastically themed. All eyes are on the new M3 chip lineup, which relies on advanced tech to boost performance and graphics horsepower. Joining us from San Francisco, back for more, is Bloomberg's Ed Ludlow. Ed, how much does this really move the dial ahead of earnings in 2 days?
Well, the timing is curious. It was scary fast, by the way, about 30 minutes, the shortest Apple product unveil that I've seen. But of course, nothing that was announced across the new Mac lineup is going to have an impact on the fiscal fourth quarter, which gets announced Thursday. Basically, what we got is a new iMac and 3 variants of the new MacBook Pro, all powered by 3-nanometer M3 chips. It's the first time that any volume producer of PCs has put a 3-nanometer built chip into their hardware, and there's a sort of ascending scale, M3, M3 Pro, and M3 Max, which as you go up that ascending scale has an increased number of CPU cores and GPU cores and performance. And what Apple is hoping on, the outside of the fiscal fourth that they report Thursday, is this puts them back on track in the PC market. Something the sell side's responding to this morning is looking at what's announced and saying, okay, this could drive an upgrade cycle for consumers around the world who either have the Apple hardware that has the M1 processor, the first generation of Apple in-house silicon, or they have the most powerful Intel-powered PCs.
Yeah.
And something that Apple said during the presentation is that their most powerful MacBook is 11 times faster than Intel. That's the battleground. The expectation Thursday, fourth consecutive quarter of overall sales decline, which the market is bracing for.
Well, that's exactly where I wanted to go, Ed. Just quickly here, just to underscore the point, how much is this trying to give some decoration to take the noise off of what they're going to report on Thursday?
Yeah, it's worrying because you have to go back more than 2 decades for Apple to have 4 straight quarters of sales declines. They've been candid that in North America, the PC market and the smartphone market is weak. China was a bright spot in the fiscal third, but the third-party data says that China won't save the day this time around.
Ed, thank you so much. As always, wonderful reporting. Sticking with tech, Apple isn't the only company set to report earnings this week. With results from chip giants AMD and Qualcomm still in the pipeline, Katie Greifeld joining us for more. So far, the story very much, Katie, has been the reaction to some of these earnings, which has been punishing, particularly for anything that's amiss. What are you watching?
Yeah, that's the word to use, punishing. It has been a punishing earnings season so far. We still have plenty of mega caps set to report earnings, and we'll see if they can reset the narrative here, because so far, before we get to Apple on Thursday, we have Qualcomm tomorrow, AMD after the bell today, and this is really a tale of 2 chip giants. You take a look at AMD, and successfully taken on Intel. It's aiming for NVIDIA's fortune with its new AI accelerator chip. All of that has powered AMD to a 46% rally year to date. Then you take a look at Qualcomm, meanwhile. It's been plagued by sluggish smartphone demand, prolonged inventory struggles. All of that has left shares about 2% lower year to date. It's going to be really interesting and important to see how this settles over the next couple of days.
At this point, we've been seeing that those that beat kind of get like a tepid applause, and those that miss see their stocks tank. How much is this even more so for the big tech sphere, the Magnificent Seven, given the fact that those shares have driven the gains so far this year in headline indexes?
Well, that's the thing, Lisa. Investors are really looking for a reason to either justify the rally or to actually resume their buying. And so far, if you take a look at the commentary, if you take a look at the numbers, that really hasn't been provided. And the stakes are a lot higher after we've seen these double-digit rallies and then some from some of these really huge companies.
At this point, Katie, is there one sector that's outperforming, or is it pretty much story by story, company by company, execution by execution?
You know, that's what I've been looking for, and it feels really idiosyncratic at this point, because you have the likes of McDonald's that still have pricing power, for example, and then you take some of their retail peers, and it just doesn't exist. So it really depends on the company, on the C-suite, and really what their actions have been to this point.
Katie, thank you so much. My partner in crime when it comes to Halloween decor. For some of the sector price action that's really getting our attention this morning, let's head over over to Bloomberg's Abigail Doolittle. Abby, what you see out there?
Well, Lisa, we have this small loss for the S&P 500 right now, down about 1/4%. Not surprisingly, most sectors are lower, but not a ton of drama beneath the surface, as John would like to say. Tech is the worst sector, down about 0.9%, and this even as yields are lower, so we're not getting any relief there. We also have energy, communication services down, real estate and utilities. Well, because yields are down, those of course are the dividend-rich sectors, so those dividends look a little more attractive this morning. Those sectors are bid higher. Now, earlier we were talking about JetBlue, those shares plunging. Isabel Lee, I should say, was talking about it. And the airline index, even though JetBlue is not a part of this index, today and over, frankly, the last month and from July even, down sharply, but this month down about 17%. Some of the big airlines down in sympathy with JetBlue.
Costs going up and not able to pass it along to the customers in the same kind of way as places like McDonald's. Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. Finding a little bit of weakness as the session grows older. A spooky morning on this Halloween. A question of NASDAQ underperforming, down 0.6%. Time now for the Trading Diary. What you need to be watching this week. U.S. consumer confidence coming at the top of the hour. Wednesday, FOMC rate decision followed by Chair Powell's news conference, and of course, the Treasury refunding announcement, as well as ADP private payrolls. JOLTS data, it's really a massive week for labor market data. Thursday, more data, including jobless claims and durable goods. Apple reporting earnings. And Friday, the October payrolls report. Right now, what you are seeing in markets is a fading after the employment cost index came out better or hotter than expected. This was Countdown to the Open. John should be back by tomorrow. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays only on Bloomberg. Context changes everything. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Happy Halloween, everyone. Coming up today, we're going to check in with Ira Jersey. He's the chief U.S. interest rate strategist for Bloomberg Intelligence. See if we can get a little preview of what we might hear from the Federal Reserve tomorrow. Chris Ciolino, he's with Bloomberg Intelligence. He's the analyst that covers Caterpillar. They reported some numbers today. Talk about industrial America. That is Caterpillar, so we'll break down those numbers. Then we can get a market call here on the high yield space. Ken Monahan, co-director of high yield at Amundi US. I'm talking about high yield, but I just want to talk about the private credit business because that's where a lot of money is going. But let's kick this hour off with John Tucker and the Bloomberg Business Flash.
All right, since we're data dependent, let's start there. Conference Board out with its Consumer Confidence Index, among other things. Higher than expectations, a little lower from the prior reading, and the prior reading also revised higher. Major stock averages on track to finish October with a third straight month of losses. 8 of the 11 major industry groups in the S&P 500 lower right now. Tech shares leading the declines and weighing on the Dow. You have shares of Caterpillar after kind of a shaky outlook. Shares down almost 5.5% there. Emily Rowland at JH Investments says there's plenty for investors to be afraid of this Halloween.
My biggest fear is that we're actually in a scary movie right now, but it's not over yet. You know, you think about the villain kind of being wounded but still alive, and the villain is higher borrowing costs in the wake of the Fed raising interest rates in the shortest amount of time and the greatest extent in several decades.
And earlier we got the employment cost index that came in hotter than expected. Signs of wage inflation there. S&P 500 down 11, down 0.3%, 41.55 of the index. The Dow 135 points lower. That's down 0.4%. NASDAQ 100 down 77 points. That is down 0.5% right now. The 10-year yield 2 basis points lower. We're at 4.87. And congratulations, homeowners. Home prices in the U.S. reaching a new high in August. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Market's definitely selling off here. We had the futures were higher. Then we got some of this economic data coming out. People saying, maybe the Fed's just going to, sit where they are here. But we'll hear from the Fed tomorrow, so we'll get it
people were saying maybe the Fed's going to sit where they are yesterday, and they will be saying that tomorrow as well.
Exactly. Exactly.
I mean, we've known that the Fed isn't going to do anything, but it's interesting to see, consumer confidence actually stronger than anticipated. 102.6, we were looking for 100.5.
Yep, absolutely. So go figure, the consumer hanging in there. Maybe they get a paycheck and their retail sales are pretty solid.
Let's talk to a consumer right now.
Let's talk
who
to a consumer.
top-ticked the housing market.
Yes, he did.
Bailey Lipschultz joins us from Bloomberg News. He covers
and
stocks.
The mortgage rate pretty darn close to the mortgage rate.
Yeah, true.
He's all in.
Just kind of buying at the highs there. It's not what you're supposed to do, dude.
But it's a long-term investment, Bailey.
Yes. That's what they tell me. That's
Bailey
what
Lipschultz.
Everyone, my loan guy told me that it's a great investment, and I will be paying this off for the next 30 years and then refinance, so I pay it off in forever. Anyway, notable underperformers this morning, though. It could be a little bit driven by Caterpillar, ticker CAT, down 5.7%. Shrinking backlog, stoking demand worries. I don't know where you guys sit on potential slowdown or geopolitically or globally and kind of some of the expectations of things going on in China, but they talked about improving supply chain conditions, but still does not seem very optimistic for 4Q. Another company that's under notable pressure this morning, Catalent, ticker CTLT. They are down because Sarepta Therapeutics, one of the biotechs that I covered a few years ago when I used to pay a lot of attention to the beat, tumbling as much as 49%, lowest level since 2018. Late-stage study of their Duchenne muscular dystrophy gene therapy, missing their primary endpoint. Catalent is their supplier for that drug, so we're seeing continued weakness in biotech in some of these healthcare.
All right, so on the biotech side, are there any investors who consistently perform well? Because to me, it is so risky on these biotechs. It's either binary. It either works and you make a ton of money or it doesn't. So you have to be some super duper smart, PhD biology, something to have an edge, I would think.
Yeah, no, and I used to talk to a handful of them. Baker Brothers is one that comes to mind. Orbimed's another. Avoro Capital they're the fourth largest holder in Sarepta. The big thing with a lot of these companies is they get in so early. So they buy these, they help form some of these drugs or companies when the drugs are discovered at the likes of a Harvard or a Penn. And then even if you get in and it's seated at $10 million, you're doing pretty well when it gets to $10 billion, even if it's like Sarepta and has a flop like we saw today.
Yep.
To the upside, though, Pinterest up 16%. Profit margins growth rate beating expectations. B of A upgrading shares after the solid report, ticker PINS. So seeing some strength in some of the corners of the market, but a number of underperformers helping drag key averages lower.
You see JBlue?
Yeah, were they blaming like air traffic control or something?
In fact, I just recently interviewed this CFO, Ursula Hurley, for Chief Future Officer, which is a program that we do here at Bloomberg. Okay. So half-hour focus on her and on Ursula Hurley's job and on JetBlue as well. She says in the statement today, while we have been able to offset some of the cost associated with the challenging operational backdrop and JetBlue has said, air traffic control limits as well as too many seats across the industry are hurting it. She said, the sheer magnitude of the air traffic control and weather-related delays has been staggering.
I don't know.
Is she blaming Ozempic?
Weather. The weather.
Oh, the weather. Sorry.
It sounds like a retailer.
Exactly. They're saying, the delays because of the weather are just...
I thought this was a bigger company.
Too costly.
$1.2 billion market cap. I thought it was a bigger company than that.
It was a bigger company.
It was? I mean, I'm not a JetBlue airport person. I'm a United, because I'm Newark. Anybody flown JetBlue?
I've flown JetBlue quite often.
And
you know,
like it?
Yeah, it's a great. They used to have a direct flight to CMH, to John Glenn International Airport in Columbus, and I also sometimes fly to Florida. You know, JetBlue has a great Florida leg. They were the first airline to have TVs in every seat back. You know, and at the time that was like awesome. You got on the plane, and even in luggage class, you were able to watch TV the whole time, which made the 3-hour trip luggage to the Bahamas much faster. And look, the stock is trading for $350 right now.
Yep.
It was, 21
Yep.
back in 2021.
I'm just looking at the FA function in terms of revenue. $8 billion in 2019, down to $3 billion in 2020. But now we're back to forecast for this year, almost $10 billion back. So, man, what a move for those airlines. Bailey, anything else we're looking at here?
Vans owner VF Corp, ticker VFC, more than 3 times the size of JetBlue, mind you. Down 9%, pulling their guidance for the full year, saying they don't expect performance at their Vans brand to improve in the second half of the year. North Face holding up better than expected. But
those are good brands.
I'm a big Vans fan. I mean,
you were
Southern
my number
California,
3 offspring's a big Vans person living in Denver. Yeah.
I was going to say it's kind of a slacker brand.
Right, spot on.
Does that track?
Yeah. Now he works at. He graduated college, and I was working at Fidelity Investments. Go figure.
Yeah. I mean, for me, Vans will always and forever remind me of Jeff Spicoli.
Yes.
You know. I mean, Fast Times at Ridgemont High made that brand what it is today.
That's a good point.
That's
a good point.
I would say it doesn't hurt when you have like the entire skating culture being built on Vans.
Yeah, sure.
That's exactly.
But that's why Spicoli was wearing them.
And, and Bailey's a California guy, so that makes sense. He's on brand. All right, Bailey, thanks so much for joining us. Bailey Lipschultz, our brand ambassador for Vans and Slackerdom. That's our guy. That's our equities reporter. Let's talk to Ira Jersey here, Chief U.S. Interest Rate Strategist. Ira, I just saw
thank God.
Michael McKee leaving here. He's going to hop on the Acela train, get down to Washington, D.C. for that Fed meeting tomorrow, where he can heckle the chairman with some questions. What do you want to hear from Fed Chairman Jay Powell tomorrow after the release of the results there?
Well, what I'd like to hear and what we're not going to hear is going to wind up being what's the Fed's reaction function and for when they might cut or raise interest rates. Obviously, if inflation accelerates meaningfully, they'll raise interest rates again. They've already mentioned that they might have to do more if inflation does accelerate, although we got some data today that seems like maybe it is going to moderate a little bit. But really, what will it take for them to cut? And I think that the idea that they're going to remain at the peak for some time, which they've hounded on, it would be helpful for them, I think, to basically be a little bit more explicit. Like, look, we're not cutting unless the unemployment rate is, 3-4 percentage points higher than where it is, and inflation is close to our target, right? So saying something like that, which isn't completely explicit, but it still has some meaning around it for markets. I think that would be helpful for the Fed to maintain monetary policy at this pace.
Close to our target is weak talk.
Weak talk?
Weak sauce. Right? I mean,
you want a hawkish?
Why don't they say, like, we want to get to 2%, to our target, I mean, at least for 6 months or a year. I mean, weren't they trying to average, long-term average 2%? And how many decades would that take?
Yeah, well, that was their old framework. It wouldn't take that long because remember we were at under 2% at least for quite a while in the last decade. I think the thing for the Fed though is that if inflation is 2.7%, 2.6%, 2.5% trending lower, and you had a real spike in unemployment, then everyone would be forecasting inflation to be significantly lower, right? And I think that's the reason why they can say like near our target or approaching our target, right? Something like that. So the Fed doesn't like to be as explicit as saying, look, we will cut interest rates if the unemployment rate is above 5% and inflation is at 2%. If they won't be as explicit as that because they want to leave themselves flexibility in case there's a crisis, if there's massive corporate defaults, for example, and unemployment spikes, but you still have year-over-year inflation hasn't fallen off a cliff yet. They always want to leave some of that flexibility. But what's interesting about the Fed is it's that little minutia and detail that's going to matter, because the Fed's probably not going to do anything tomorrow. The Treasury Department, though, at 8:30 in the morning is going to give us some information that might actually be market moving.
So, yeah, I mean, yesterday we heard from, I guess, Treasury that they need about, what, $800 billion in this quarter?
$776 billion, right, in this quarter of net debt raise, effectively. That's a little bit higher than what our expectation was, a little bit lower than most expectations, and the reason is that they want to keep this pretty big cash balance. They want to keep a cash balance of around $750 billion. So in order to do that, with Social Security payments coming and additional payments for Medicare, as well as just general government deficits, not to mention interest payments on the debt, they're going to have to raise quite a lot of money. Now, interestingly, remember that $776 billion is what they're selling to the public. It's actually not the total debt that's being raised, because there's non-marketable debt, so debt from the Social Security Trust Fund and some other trust funds that are being paid down. So what you'll see is a deficit for the quarter of around half a $1 trillion, around $500 billion. But the actual debt that they need to raise is much more than that, because of the things that we've known for 30 years, right? The Social Security Trust Fund is a net negative, and that has to be funded out of general revenue. So it's all the problems that we've seen over the last 25 years, and we said we're going to be problems for the government debt, are actually coming home to roost right now.
So, Ira, I mean, nobody likes to ignore Treasury auctions more than me, but you tell me I now have to pay attention to this?
Well, they've been important. They've been market-moving events. When you look at auction demand, the last couple of weeks, they've started to slip a little bit on average. Last week, for example, we had pretty weak auctions for 2-year debt and 5-year notes, but the 7-year on Thursday went okay. But I would say that demand is much more mixed. Prior to this past month or so, we actually had pretty decent demand at auctions. People were, I think, were taking advantage of the sell-off. We, hit 5% on 10-year notes, and people had, taking a little stab at maybe owning a little bit more at auction. So yeah, we need to see if demand is maintained, particularly since tomorrow morning, with all of that $700 billion of debt that needs to be raised, there's going to have to the government's going to have to increase the size of auctions almost across the board.
So I'm looking at the 210s. That's another thing you got me looking at, unfortunately. Still inverted, but much less than it was before. Now only about 20 basis points or so. Are we going to get to a point where we actually have longer-term yields higher than shorter-term yields?
Yeah, I think we will, and it will probably happen early next year. I think it really depends, though. The important nuance of that is it because 2-year yields go down a lot? So do we have a weakening economy? Is Anna Wong and the Bloomberg economics team correct? And if we do have a meaningful slowdown in the economy, we could probably see 2-year yields go down 25, 50 basis points, and 10-year yields go down less than that. And that's how you wind up getting that positively sloped yield curve. On the other side, if the economy stays reasonably robust, but only because we have all of this debt issuance, you could see 10-year yields maybe up above 5%, up to 5.25, 5.3%, and that could uninvert the yield curve, and that would not surprise me at all. In fact, we actually think that we are in the process of completely uninverting, and we do expect to see a positively sloped yield curve sometime over the next 12 months.
You raised an interesting point that Treasury Secretary Janet Yellen last week, she said the reason we have high yields is not to do with the debt and deficits, nothing to do with that. Look away from there. Don't look there. It's because of the strength of the economy, because of Bidenomics, from the middle out, from the, what is it? Middle out and I can't remember.
Belly, you mean?
He says he has a catchphrase that he uses. Bottom up and middle out. That's what it is. So is that the case? And will we know from the refunding how much of the rise in yields is due to the high debt and deficits, and how much of it is due to the speeding economy?
these are only things that can be estimated, but our estimate is that around 92% of the move from the July Fed meeting to present in the 10-year yield has been due to the shift in Fed expectations. And so if you go and you look at what the expectation is that the market's been pricing, we were pricing for 2.5% Fed funds rate in 2025. We're now pricing for 4% in 2025. So that's a huge move, right? I'm talking about a 150 basis point move up in where the Fed is going to cut to, or where the market thinks it's going to cut to. So that had to manifest itself all throughout the Treasury curve, and in particular in the longer end, because the longer end was anticipating rates to be much lower and policy rates to be much lower a few years from now. So I think the debt dynamics do have some effect, and they certainly have effect on liquidity. But
all right, we're going to just leave it there, but we appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paulie. The United Auto Workers may have reached a tentative agreement with all three of Detroit's big automakers, but they're not done yet. The UAW is already planning to make April 30th, 2028, the contract's expiration date, a call to arms for the entire organized labor movement. Now, union head Sean Fain is calling for other labor groups not only to strike, but to strike alongside each other in a single pushback against what he calls the billionaire class. Checking in with the big three right now, we have Ford up more than 2.5%, Stellantis up about 4%, and General Motors up more than 1.5%. Now, Fain also says the UAW has their sights set on automakers in the U.S. that employ non-union workers, saying that when they return to the bargaining table in 2028, it won't just be with the big three, but with the big five or the big six. Bloomberg's Joan Doniger has more on one car maker that may be part of its plan.
Musk's Tesla could be the next target for the United Auto Workers Union, fresh off what it says is its victory over Detroit's Big Three. Tesla's plant in California has a UAW organizing committee whose members are talking to co-workers about why they should form a bargaining unit, but Musk is notoriously anti-union and has pushed back hard against previous union drives there.
Shares of Tesla right now up more than 1%. And Stellantis says strikes that curbed output at its North American facilities cost the Jeep maker more than $3 billion in revenue. But the company still reported better than expected third quarter revenue, boosted by stable pricing, improving logistics, and growing demand for models such as the electric Jeep Avenger. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major averages have now turned mixed to little change. The S&P 500 still on track for its third monthly slide. It would be the longest losing streak since March of 2020. And then you have NVIDIA dropping right now 3.1%. That's leading the declines in the mega caps. Caterpillar, the biggest drag of the Dow, after its shaky earnings, that's down close to 5%. On the data front, the employment costs unexpectedly accelerating in the third quarter. That heightens concerns that a strong labor market is going to keep inflation higher. S&P 500, 3 points higher right now. The Dow Jones Industrial Average down 34. The NASDAQ 100, 15 points lower. And home prices setting a new high in August after 7 straight months of gains. Cities reaching all-time highs in the CoreLogic Home Price Survey include New York, Boston, Miami, and Atlanta. And the reason? A scarcity of listings. No, I'm not going to sell.
No.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Bloomberg Markets today is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Caterpillar, they make the big tractors and all that kind of good stuff, backhoes. They reported some numbers today which were in line, I guess pretty solid, but it's all about the outlook for these long cycle industrial companies, and that's what's got some investors spooked here. As John mentioned, the stock's down about 5% here today. Let's break it down with the man who knows what's happening with this company, Chris Ciolino. He covers the big industrial companies for Bloomberg Intelligence. He's located down in Princeton, New Jersey, the HQ, if you will, of Bloomberg Intelligence. Hey, Chris, talk to us about Caterpillar. You've been calling out, I know in the last few quarters we've been speaking to you about, boy, these companies are putting up great numbers, but investors are really looking forward and they're a little bit concerned. That seemed to come to fruition here today. What'd you see?
Yeah, I mean, to your point, I mean, the quarter was fine. Actually, was quite good with better than expected margin performance and earnings. Pricing continues to be really strong, but what we saw was a pretty broad deterioration when it comes to their leading indicators. Backlog fell for the first time in 3 years. Implied orders also dropped sequentially and year over year. And their fourth quarter sales outlook was somewhat kind of disappointing and below normal seasonality and consensus. And there was a fair amount of trepidation about the macro backdrop heading into the print. And I think these softer orders and backlog trends that we saw aren't necessarily encouraging and what is likely to be a softer economic environment next year, and really just kind of intensify some of those concerns around the duration of the cycle.
Yeah, so we saw the year-on-year decline of $1.9 billion in the backlog. What exactly does that mean? Does that mean, exactly what I think it does, that they had orders that were that much lower? I mean, how much was the backlog in total?
Yeah, so I would say the moderation in the backlog wasn't necessarily a surprise, and I think it was somewhat to be expected, just given normalizing supply chains and some of the lead time shrinking with some of the product availability. But I think the magnitude of the decline was kind of what spooked people, particularly on the order front. Orders were down about 15% versus the prior year and 20% sequentially. So I think that sheer magnitude and just the optics of
But what's the magnitude of is a $1.9 billion drop a 10% drop in the backlog, or is it a 50% drop in the backlog?
No, it's an 8.5% decline sequentially. So but it's the first time we've seen backlogs essentially peaked. This is the first time we've seen it decline.
Sequentially, so you're not talking about the year-over-year drop.
Yeah.
Right.
Yeah, I can see how that would spook people. What's Cat saying about are there any particular customer segments that are maybe weaker than expected? What are they saying about kind of where this might be coming from?
Yeah, I think I'll actually maybe start on the construction side. I think that was one positive surprise, particularly in North America. North America continues to be quite resilient, and end user demand continues to be pretty strong, really across their business. The energy and transportation business came in a little bit weaker than we had anticipated, and there was some softness on the mining side on the top line. It seems to be some timing issues, but also there was some weakness in the aftermarket business, which was a little surprising just given the age of the fleet, and utilization still remains quite high. So those bear kind of watching going forward here.
So give us a sense of a cycle here for like a Caterpillar. I mean, you said this is the first time in 3 years they've had down orders sequentially. That sounds like a pretty good cycle, but are down cycles similarly like in length?
No, as much as we like to think every cycle is the same, they tend to be different. And I would say, even though backlog had peaked here, we are still at historically very elevated levels, and there is really above average production visibility as we look forward to next year. But the optics are, you have really a cyclical company with declining orders, a declining backlog. It doesn't, just the optics of that are not a favorable setup for the company moving into next year.
How about the Inflation Reduction Act? Isn't that like lots of Caterpillar type stuff you need?
So it is, and I guess one of the caveats with this cycle is it's different because we just have an immense amount of fiscal stimulus coming through the pipe, and I'd say a lot of that has really kind of yet to materialize into the financial results of a lot of these companies, and it's part of what's propping up the backlog here. So I think that does help provide an offset. I think some of the decline is certainly attributable to the normalizing supply chain and shrinking lead time. So maybe a little bit of an overreaction, but this will certainly provide a multi-year tailwind for the company, and really probably provides a little bit more of a favorable outlook for a lot of the construction machinery producers relative to some of the other machinery end markets.
What are the biggest competitors, and do they face a threat there? I look through all the names on the RV page on the Bloomberg, and I don't see anything that really stands out as, a household name other than maybe Mitsubishi. But, who are they facing off against?
Yeah, so they're the undisputed leader in the construction machinery space. When it comes to mining, it's essentially a duopoly with them and Komatsu. And Komatsu's a pretty significant player on the construction side as well. Everyone else tends to be subscale. They do compete with Deere also on construction. They're starting to grow their construction business. So I would expect them to be a more formidable competitor in the years to come. But really, it's Cat and Komatsu. Those are the dominant forces in the market.
How about geographies, Chris, particularly China? What's their exposure to China, and what are they saying about China?
China's weak and continues to weaken. Really no signs of a turnaround yet. So, historically, China's been roughly 5 to 10% of consolidated sales at Caterpillar. This year, we're going to be well below the 5%, and the lowest in quite some time. Not really hearing any sort of optimism coming out of that region.
And how about Europe? Because I know I can see here on the PGEO page, that's EAME is about 20% of revenue. What are they seeing out of Europe? Because I know people are concerned about that, those economies over there.
Yeah, and that actually held up a little better than I had anticipated. We're just starting to hear this earnings season from a number of other machinery producers that there had been some weakening in the sentiment over in Europe, and even some softer orders. Didn't really get that coming out of Cat, and some of their retail sales trends didn't seem to suggest a significant deterioration there yet. So again, another item worth kind of monitoring moving forward.
We just saw the Eurostat growth figures, by the way, Paul.
Yeah.
So the European economy contracted 0.1% in the third quarter, and we were looking for just a stagnation. So it's getting smaller there. I guess consumer prices are coming down, which is good. They got a 2 handle on them, 2.9% in October.
Okay.
Yeah.
Hey, Chris, just looking ahead a little bit, my good friends at John Deere, the nice green tractors, are reporting in a few weeks here. And, I always love to look at the Deere results because it gives you a great handle on kind of how the state of the farmer out there. How are things at Deere?
So I think Deere is going to have a more challenging setup into 2024 relative to Cat. We think the ag market has already peaked, so we're kind of anticipating single-digit volume declines next year. Now, remember, Deere will report their fiscal 4Q results later in November, so they'll provide the kind of first look at 2024, but we're certainly expecting a lower volume market on the ag side. We're coming off a number of strong years, but you're starting to see commodity prices, row crop soften quite a bit. Farmer income is going to be down 25% this year, so
really?
I'd say a less favorable outlook on the ag side in 2024.
And the farmer, when the farmer has cash, he or she goes out and buys tractors and stuff like that. But it's a cyclical business, so the flip side is true, right?
Yeah, and the magnitude numbers sound pretty draconian, but I think we'll still be, second or third highest all time in terms of net farm income. So we'll be down from a peak in 2022. It's still going to be historically strong, but I would just expect farmers to dial back some of the spending, just given what's going on with some of the farm fundamentals and again, the weaker crop prices that we've seen.
All right, great stuff. I'm just looking at Deere right now. The stock's off about 15% year to date. So there's the market discounting a good 12 to 18 months in the future on that name. Chris Ciolino, we always appreciate getting a few minutes of his time. He's the industrials analyst at Bloomberg Intelligence, zooming in from Princeton, New Jersey.
On Caterpillar, which is, by the way, Caterpillar is down 6% so far in today's session.
Yeah, it's a big move.
And they're only down less than 5% year to date.
Yeah,
so
absolutely.
All of the year-to-date drop comes from this day.
Yeah, on a trailing 12-month basis, up about 7%. So again, you look at these big long-cycle industrials, the market really does try to get a peek around the corner where that demand will be, given the cyclicality of the business. S&P 500 absolutely unched on the day, giving that term out there for Lisa Abramowitz. Right now, let's head down to Washington, D.C. because they have world and national news down there with Amy Mars.
All right, thank you, Paul. Israel struck more targets in Lebanon and Syria overnight, stepping up its ground operations in Gaza. This as Prime Minister Benjamin Netanyahu ruled out a ceasefire, adding he has no plans to step down despite mounting anger over Israel's failure to prevent the worst surprise attack on the country in a half-century. Bloomberg's Roz Matheson has more on Netanyahu's message.
So it's very much about sending a message that he's nowhere near resigning. In fact, he was asked in the press conference if he would resign. The answer was a resounding no, he was not going to resign. So it's about also his own personal leadership in this minute.
Bloomberg's Roz Matheson was on Bloomberg Daybreak. President Biden's two top foreign policy lieutenants are testifying in the Senate today on behalf of a $105 billion request to support Israel, Ukraine, and other security priorities. And we talked about that with Jody Schneider, the political news director for Bloomberg TV and Radio. She tells us Defense Secretary and Secretary of State are both taking their message to a friendly audience first.
This is a huge package, $105 billion emergency aid. It's a request for both, as you noted, Israel and Ukraine, and it's going to hit roadblocks they know once it gets to the House.
Jody Schneider, political news director for Bloomberg TV and Radio on Bloomberg Daybreak. Now, Republicans in the House of Representatives have also come up with their own aid package. It is much smaller and it only provides aid for Israel. They do not expect it to make it past the Senate. And the cast of Friends says they are utterly devastated by the loss of co-star Matthew Perry. Jennifer Aniston, Courtney Cox, Lisa Kudrow, and Matt LeBlanc and David Schwimmer issued a statement saying the group was more than castmates. They were like a family. Perry was found at his Los Angeles home on Saturday, where it appears to have drowned. The autopsy results will not be available for several weeks. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Major averages are lower right now. S&P 500 down 7 points, the decline of 0.2%. Dow Jones Industrial Average 75 points lower. The NASDAQ 100 down 66 points. That is down 0.5%. Third quarter earnings reporting season pushes forward. Caterpillar shares under pressure, even with a third quarter profit beat. The outlook for the fourth quarter raising concerns there. Then you have Pfizer shares also lower at a wider than expected loss. On the interest rate front, we may have seen the peak, according to Madison Fowler at JP Morgan Chase.
So I do think that you could see some spikes from here. But again, to bring it back to the fact that higher bond yields do act to, ultimately slow economic momentum, we do think that the path lower for interest rates is ultimately lower over the course of the next 12 months.
And the 10-year, the benchmark down 3 basis points right now, 486. Central bankers have some more information today on labor costs for employers. Worker compensation increasing 1.1% during the third quarter. That was higher than expected. Parts of the United States paying under $3 a gallon for gasoline. Really? Houston, the price of the pump an average $2.89 a gallon for regular unleaded. That's according to new data from the Energy Department. Compare that to San Francisco. You want to take a guess?
$6.50.
No, well, $5.13 a gallon.
Yeah, okay, but it was over $7 there for a while.
$5.13 a gallon I can find in Westchester.
Well,
so you don't need to go all the way to San Francisco.
You'll come down to the Wawa on Route 36 in Monmouth County.
Yes.
And I think it was $3.33 this morning.
Nice.
Thereabouts.
And he's got to gas up like 4 times a week.
Yeah.
He's got like 700 miles back and forth.
You got to get a more economical box.
Might go electric at some point. Put some solar panels on the roof.
Yeah. Now we're talking.
Just crawl to work.
Exactly. All right, very good. John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So check out that youtube.com and search Bloomberg Radio. I'm looking at INGO. That is the Bloomberg Index browser. Kind of gives you the performance year to date, month to date of all the big indexes out there. And for the fixed income space in the U.S., it is red with one exception. U.S. corporate high yield up 4.38%. Why is that? Let's check in with our next guest, Ken Monahan, co-director of high yield at Amundi U.S. He's based in Durham, North Carolina, but up here in New York. Ken, 2022, as we've talked about before, was the mother of all disasters for fixed income investors. This year's not much better through the first 9-10 months. What's going on in the corporate high yield market? Why is that showing some positive returns?
Well, you're right, Paul. I think that it's been a reasonable year considering how bad we've had in the past, and it's a decent year, and it's a year where risk is outperformed. Now, October thus far has been miserable for risk, but if you're looking at the year to date, we see the triple C credits are up, really threefold what double Bs are. So we've had a fair amount of spread compression.
So, but I mean, everybody's been telling Matt and I that we're going to have a recession any day now. If that's the case, why are people taking incremental risk that they do when they go into the high
spreads? I mean, if you're paying me, I get it. But if you're not paying me, why am I buying it?
Well, if you look at spreads where they are right now, arguably they're only at the 5 and 10 year averages, so they're not looking particularly cheap. On the other hand, that the economy's done pretty well, and I think that that's really what's been driving spreads. Is we'd all been waiting or expecting a recession, whether it was in the later half of the early part of the first half of the year, or then the back half of this year, and then people are forecasting it for early 2024. And thus far, the economy's continued to power through, and I think that's what's been driving spreads.
But aren't you worried that defaults are going to start to pick up?
Well, interestingly enough, if you look at the Moody's estimates, they're expecting defaults will peak sometime in the spring of next year, but at a fairly reasonable rate. But let's remember, when Moody's puts out its numbers, it is an unweighted number. So they count a $100 million default the same way they count a $1 billion default. If you look at it on a adjusted basis, where they're using weightings based on the amount of debt outstanding, the default rate for this year is still running under 2%. Now, they're expecting the default rate to rise into the mid to high 4s. But that's a pretty big differential. So what it tells us is the companies that are getting into more difficulty tend to be smaller companies rather than larger ones at this point.
What's the new issue market like? I used to love throwing out some high yield for my clients back in the day because I love the media cable paper. What's the new issue market like these days?
It's pretty soft right now, not surprisingly. I think we had a pretty robust calendar coming into September, and that there were a number of companies that had financings, whether it was M&A related or LBO related, that needed to get done, and they got those done. But since then, obviously, treasuries have risen fairly dramatically. And then on the back of the 50 beeps treasury move we've had in the last 4 or 5 weeks, we've had about a 75 basis point widening of high yield. So I think companies have taken a step back and said, let's wait a minute here. Let's hope that spreads get tighter, or hope that treasury rates come down and moderate, and we'll find a better financing opportunity. Now, the problem with that from our perspective is if you wait too long, and we are right, and we do see more of an economic slowdown in 2024, which is what our expectation is, that would imply, as you're suggesting, that spreads ought to be wider, not tighter. And if spreads are not wider, then the Fed's likely to keep its foot on the brake pretty hard, because that says the economy's powering along too strongly, and they're going to have to react.
Right,
So,
or else you're playing along too much. You need to get a little bit more vigilante, don't you? What can you do, by the way, in terms of, pivoting your strategy? Can you go up in quality if you're co-director of high yield?
Sure, yeah, and we've been doing a fair amount of that. And I think then the other thing you do is you go into sectors where you have a greater degree of certainty. So, we look, affluent consumers are still spending. Cruise ship companies happen to be doing extremely well. And actually, if you look at their bookings through 2024, they're solidly booked. We've seen some softness in the airline space, but the cruise ships happen to be different. Even if you're looking at something like home builders, you would say to yourself, well, how could home builders be doing well in this kind of environment? Well, right is the competitiveness of wireless alternatives. And then there was cord cutting is obviously going on. But I think we've seen some changes in the last several months.
But they always pay their interest in principal, though.
Yeah, they are always paying their interest in principal. And I think, think about how many of us are still working from home at least part-time, maybe not in the office every day of the week. And those people need broadband
All right, what's the
access.
average office professional in Durham, North Carolina? What are they doing? How many days a week back in the office?
I'm going to say we're in at least 3 days a week. And I'm going to say that's what most people are doing.
That's the new normal, man.
Yeah, no, I know it's
You
the
go
new
out in the
normal.
real world, that's what the real people are doing.
Well, I think bosses are trying to change that, but employees are fighting back.
Yeah, we just need a good recession. All right, real quick, what do you expect from your Federal Reserve tomorrow?
I think it's going to be a quiet day from the Fed. I think that there's reasons why they may go the other way and raise rates, but I don't think that that's in the cards right now. I think we're in a holding pattern.
All right. Again, looking at the IN function, the Bloomberg Index browser, U.S. mortgage-backed securities, U.S. aggregate, U.S. government credit, U.S. Treasury, U.S. universal, all down 2.34% year to date. The one exception, U.S. corporate high yield up positive 4.38% return. But as you mentioned, Ken, on the month, down 1.4%. All the bonds.
Yeah, if you look at JNK or HYG, they're not doing that great.
Yeah, so interesting stuff there.
But positive for the year.
But positive for the year. And on Friday, we'll talk with Joe Misek, talked about the municipal bond market.
I'm very much looking forward to that. Yeah.
Ken Monahan, thank you so much for joining us. Ken Monahan, co-director of High Yield for Amundi U.S., based in Durham, North Carolina, the home of a certain university. But he joins us here in our Bloomberg Interactive Broker Studio. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. Caterpillar posted earnings that topped analyst estimates, but a drop in its order backlog has shares lower. We have more from Bloomberg's Abigail Doolittle.
There was a year-over-year decline of $1.9 billion. That is the first since the third quarter of 2020, when it really had to do with pandemic supply issues and the like. So this is a bit of an outlier. And we also have Baird saying that some of the dealer inventories, well, they're continuing to grow, which essentially means that they're not going to have to order as much, showing up in the backlog. Investors nervous that this could continue.
Now, shares right now down nearly 6%. Meanwhile, shares of Pinterest, they are soaring, up about 18.5% after the social media platform reported sales that beat expectations. Bloomberg's Ed Ludlow says its shoppability strategy is paying off.
The investments they've made in artificial intelligence driving the user base to make purchases in the e-commerce context based on the images that they're looking at. A beat on the top and bottom line, revenues coming in at $763.2 million, ahead of estimates, adjusted EPS 28 cents per share. The estimate was for 20 cents. What's most interesting is the monthly active user base. 482 million users, monthly active users, is a record.
Now, a big bulk of those users, they're coming from outside the U.S., Canada, and Europe. And one thing you may come across on Pinterest, Skims. And apparently it's not just for women. Kim Kardashian's shapewear line released its first ever men's collection last week and just announced a multi-year deal to be the official underwear partner of the NBA, WNBA, and USA Basketball. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets right here, kind of a quiet day in terms of the indexes. The S&P 500 up about 0.2%. The Dow's pretty much unched, as is the NASDAQ. Yields pulling in just slightly. Got the 10-year Treasury lower by 4 basis points, now yielding 4.85%. WTI crude oil up about 0.6%, just under $83 per barrel. Bitcoin pulling back just slightly, 0.25%, now at about 34,300 on Bitcoin. Right now, let's head down to Washington, D.C. We'll get world and national news from Amy Mars.
All right, thank you, Paul. House Republicans are ready to go to the mat for a plan to provide aid to Israel, but not for Ukraine.
Speaker Mike Johnson is out with the House proposal that calls for $14.3 billion in aid to Israel, but does not contain emergency funding that the Biden administration wants for Ukraine and Taiwan. The GOP package also leaves out humanitarian assistance for civilians in Gaza and Israel that the White House had requested. And unlike emergency funding in the past, Republicans want to cover the cost of their plan by making a $14.3 billion cut in funding for the IRS that was included in Biden's Inflation Reduction Act. In Washington, Nancy Lyons, Bloomberg Radio.
And Defense Secretary Lloyd Austin and Secretary of State Antony Blinken have taken their case to the Senate to fund aid for Israel and the Ukraine all at once in the name of national security. Sam Bankman-Fried returned to the stand for more questions under cross-examination in his fraud trial. Bloomberg News legal editor Tony Ahrens has some highlights.
What was really effective is how Danielle Sassoon, the assistant U.S. attorney, used Bankman-Fried's previous statements against him, and how she just wore him down. And it just, by the end of the day, had a feeling that she had really taken a lot of chunks out of the narrative he tried to craft for the previous 2 days on the stand.
Bloomberg News legal editor Tony Ahrens covering that trial. New data show nearly 1 million illegal immigrants were processed and released by Border Patrol last fiscal year. Senator Ted Cruz talked about it during a recent trip to the Texas border with Mexico.
The men and women of the Border Patrol are frustrated because they risk their lives apprehending people only to see them let go over and over and over again.
That number does not include the illegal immigrants who were caught crossing at the ports of entry, making it likely that the total number of releases is actually higher. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg. Matt and Paul.
All right, Amy Mars, thank you so much. We appreciate that. Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. All right, here's an interesting story about the auto workers. United Auto Workers President Shawn Fain's unprecedented decision to attack all three of the big Detroit automakers at once in a chaotic 6 weeks of targeted strikes appears to have paid off for workers, yielding deals richer than the union has realized in decades. Now, after the companies have seen combined losses of about $2.9 billion, the question becomes whether they can thrive under the contract terms, Matt. And I think, you know, Ford is out there saying that we've got other efficiencies we can take out of our business to offset these higher labor costs. But I don't know, but that's $2.9 billion is a big number of losses. Plus, they now have to operate with much higher labor costs.
Yeah, but not that much higher. If you look at how much it's going to cost them to pay each employee, it's now going to be $75 to $78 an hour. That's all in with benefits. You know, they didn't have to do the pensions, which you know the union wanted. They didn't have to do the 4-day work week, which the union wanted. And right now they pay their workers about $64 an hour.
Okay.
So you're looking at, you know, at the most $14 extra in costs per hour, which is about 21% increase from what they pay him now. And, you know, I think our reporters in Detroit calculated that it's going to cost an extra like $800 to $900, $850 to $900 a car at Ford.
Yep.
In terms of the price. Well, they've already raised prices of all of their vehicles thousands and thousands of dollars over the past few years, so I think they'll be able to do it.
Yeah, I think so. So anyway, so finally got some labor peace, at least for the moment, for the next several years in the auto business, and the union saying, hey, when we come back, we're going after Tesla and some of the other non-union players, so they feel pretty good about themselves at the moment. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Dana Peterson. She's a chief economist at the Conference Board. We had some consumer confidence data out today, so we'll break that down. Plus, we need to get an update of what's happening in the European markets. Tim Craighead, he is our man in London. He's the director of research and senior European strategist for Bloomberg Intelligence. He's not going to swim across the pond here. We got him on the London camera over there, so we'll hear from him from London. So we got all that coming up. First, let's kick this hour off with John Tucker.
All right, thanks, guys. The major stock average is little changed right now. The S&P 500, 6 of the 11 major industry groups were higher. Real estate with the best performance. The biggest drag was coming from technology. You had NVIDIA Corporation, the laggard there. That was down just about 2%. And the earnings scorecard shows 281 companies in the S&P 500. They have reported so far almost 80% have delivered positive earnings surprises. Right now, the S&P 500, 8 points higher. That's up 0.2%, 4175. The Dow Jones Industrial Average, that is now positive, up 14 points. The NASDAQ 100 also climbing right now, up just 10 points. And at Blue Bay Asset Management, Mark Downing, he's ready to take advantage of any future sell-off in stocks.
We wouldn't be surprised to see investor sentiment tested at some point and a deeper correction. So were we to see the S&P trade down to 4,000 or below, were we to see credit spreads move wider, we'd like to be in a position where we can be buyers on any weakness.
The 10-year yield 4 basis points lower. That is at 484. I haven't done a yen quote. Let me give you that. Continuing weaker, 151.
Wow.
It takes, let me do this the Matt Miller way. It takes 151.24 yen to buy $1. So that number goes higher. It's weaker. And looking at, I don't know, some version of yield curve control in Japan.
It was a little bit light.
It was a little light.
I think we were expecting a little bit more yield curve control.
And Jess will be along to explain.
I mean, a little bit more.
Yen,
I'm sorry, a little bit more move away from yield curve control. Now they're going to be flexible.
The thing is, it affects everybody because they buy oodles and oodles of things like U.S. Treasuries. So if they have to sell that to then support the yen, that's going to affect markets here. I mean, that's
economics 101 right there.
Lame-o explanation for what's
it's so complicated. You got to get into the carry trade and like do backflips and.
We'll see on surveillance today. Tom Keene said euro yen is what to focus on. I have it on my screen. I have no idea.
That's what he's been saying for, dude, at least a decade. In fact, the surveillance team had T-shirts made.
Euro yen
T-shirts made about 10 years ago because that's what the pros watch.
I need a
145 was that key level recently, and it's still been above that
it's
for a while.
Dollar yen 145.
Yes,
Yeah, I know, and it's like they just blew past it.
Right.
And I thought the Bank of Japan would crunch down a little bit harder yesterday. I think we all thought that, and they didn't, which is why we're now off to the races.
Crazy stuff out there. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, breaking down some euro yen like we like to do and have a little
That
fun
was
with
it,
that.
by the way. An hour and 4 minutes into the program, we brought up the Bank of Japan, and don't expect us to come back to it.
Exactly right. All right, let's go to some economic data that came out today. Kind of surprised to me. The Conference Board consumer confidence came out a little bit better than was expected. So we can't keep a good consumer down. Let's break it down a little bit with Dana Peterson. She's the chief economist at the Conference Board, joining us via Zoom.
Wait, what's Jess doing here?
Oh, you're right. Thank you very much. Boy, what a team we are. Dana, we're going to come to you in just a minute. Hang loose on that Zoom thing out there in the ether. First, we're going to go to Jess Menden because she's got some news for us on what's happening in these equity markets. What a team.
Well, looking over, since this is the last trading day of the month, so the S&P 500, if you look month to date, down 2.7%, and then also the NASDAQ 100 down about 2.6% for the month. So both of them are on track for 3 consecutive months of losses. So the last time the S&P 500 saw that was obviously the onset of the pandemic in early 2020. A couple of different names I'm looking at, though, is as far as what's among the biggest gainers and decliners here. If you look over at Arista Networks, ticker symbol ANET, that's up about 12%, so it's on its best day. If it can maintain those gains since August 1st of this year. And really, when you're looking at that, this is a cloud networking solutions company. It did report fourth quarter adjusted EPS and revenue that did beat analyst estimates. And also, Morgan Stanley did upgrade their recommendation on the stock to overweight from equal weight. They did note that the results pointed toward continued strength in the cloud. Another one, though, Catalent on the opposite spectrum. This is among the biggest decliners in the S&P 500. CTLT is the ticker symbol on that, down 16%. So this would be its worst day since May 8th of this year. And this is definitely, when you're thinking about what's happening in some of these biotech sort of late stage names, their study of its drug in patients with muscular dystrophy between the ages of 4 through 7 years old did not meet its primary endpoint when you are looking at Sarepta Therapeutics. And so because of that, its third-party filler, which is Catalent, did tumble. And when you are looking at that, down 16%. So those two companies did enter an agreement for a commercial supply agreement back in January, so you are seeing Catalent pressured because of what's happening in that study, Paul.
All right, so Jess, if you come down to the Sweeney Jersey Shore compound, the house beer is Budweiser.
Yes.
In cans, by the way.
Seriously?
In cans.
Seriously. And if you want something else, you gotta bring your own.
Coors Light where the mountains turn blue.
Yes, when it's cold.
Yes.
So if you want something else, you got to bring your own.
I see.
I mean,
So-
I've never understood that because, like, don't you know if it's cold when you're holding the can in your hand? Do you honestly need to look at a blue mountain? I guess it's cold.
When you're floating down a river in Texas, you probably do, right?
Koozies. Well, okay, you can do that in Texas, but there are some strict regulations of what kind of containers they have to be in. It's not. No, it's a whole big thing. You'll get in trouble, and so you have to actually put them into different containers.
Dude, even in New York, you're not allowed to drink. I find this hilarious. You're not allowed to drink like a can of beer on the street unless you have it in a paper bag.
Right.
But you can smoke like a Bob Marley-sized joint, right? And blow it in anyone's face.
In a cop's face. All right, but what's going on with our good friends at Anheuser-Busch InBev NV?
Right, so you're looking at the ticker symbol is Bud on there. And I wanted to point out it is down nearly 6% for the year. So this is going, particularly when you're looking at this, the three of the world's biggest brewers are actually still confident. John Tucker over here is still laughing that they can hit their profit targets this year.
I'm just wondering, is Paul giving out Budweisers to the trick-or-treaters? Is what I picked up from that.
We really need to know later
Push
today.
comes to shove.
So obviously Maker, Budweiser, and Stella. So it did report a 5% jump in revenue in the third quarter, almost entirely driven by beer prices. So this is interesting because we've seen a lot of these different, especially when you're looking at these brewers as far as more of the spirits that have been driving sales in recent quarters, but now you're seeing higher beer prices here helping out.
In terms of the overall market, we had we reached an official correction? I mean, were we 10% down from the peak on the S&P?
On Friday is when it
okay.
actually, so it happened intraday on Thursday, and then on Friday is when the S&P 500 actually closed below that.
But now we're only off 9% by my crude math from the 45.88
and
high.
Also, the 1 year average closing price for the S&P 500 is around 41.74, and so that's sort of a key threshold, right? And so RAVG, I believe, is the ticker symbol or the terminal function to see that if you're doing GP on the S&P 500. So that's something just kind of in the near term that traders were looking hopefully to see the S&P 500 climb above that to see if it could close above that threshold today.
All right, anything else for us?
I mean, so many different things. I mean, after the bell, we still have Advanced Micro Devices that's going to be reporting. That's going to be another key, especially when it comes to the chip names. And then obviously Apple on Thursday.
Yeah, that's going to be big. Because my big thing for Apple on Thursday is China.
Yes.
What's happening with China?
Right.
You know, because it's both obviously a big source of supply for them, but then 20% of their sales go into China. Now, I wonder if the Chinese people are just going to say, we're going to just start buying Chinese stuff. We're not buying American stuff anymore.
Well, that's what the government wants them to do, right?
Yeah. So I don't know if that's just in government offices or they're really seeing it with this
that
Huawei phone
stock's
as a competitor.
off more than 10% from its July peak.
All right, very good. Jess Menton, thanks very much for joining us. Jess Menton, she covers all the markets for Bloomberg News. Appreciate getting a few minutes of her time. And
Happy Halloween.
Yeah, and happy Halloween with the orange
Happy Halloween.
Top there. Now, let's go to Dana Peterson and talk about consumer confidence. Dana Peterson, chief economist at the Conference Board. So, Dana, the confidence number, a little bit lower than last period, but better than the consensus. What did the numbers show you in terms of consumer confidence in the U.S.?
Well, I mean, this is another month where it's down. So I think even though it may have been slightly higher than what people were expecting, consumers are still cautious. They're cautious about the present situation as well as the outlook. And I think that's the story you want to take home for today.
Why are they so cautious? I mean, the consumer has a job, right? The economy is growing at a 5% clip, at least it was in the third quarter. Have they just spent all their money and they're racking up debt?
Well, when we ask them what's wrong, they're still complaining about inflation, food and energy prices still elevated. They're starting to complain more about interest rates being high, and they're also worried about what's going on in Washington, D.C. So folding all those things together, yes, they are working, but they think there's something bad around the corner. Maybe they won't be working later on over the next 6 months or so, or maybe they'll see their incomes not as robust as they are right now.
So, Dana, we see the Conference Board expectations looking forward came in at 75.6. Last month was revised higher as well. Where do we want to see that number? You know, if we want to see, hey, maybe the consumer's doing okay as he or she looks outward.
Well, we basically want to see it above 80. 80 is a threshold where any number below it means consumers think that there is a recession in the pipeline. So even though the number was revised up slightly in the previous month, it was still below 80. So consumers think something's going on. When we explicitly ask them, do you expect a recession? It's still pretty elevated, you know, pretty close to 70%, but it's not as bad as they were thinking earlier this year.
So does that mean we expect a turnaround, or are you worried about the economic outlook?
Well, it's still our forecast that we will have a recession in the first half of 2024. When you think about it, again, that GDP number was in the past. Now in the fourth quarter, people have to pay down their student loans. The excess savings is running out. Many people, especially at the lower end of the income spectrum, have levered up. They're experiencing delinquencies in their credit card payments. All that doesn't signal good news. And certainly when we look at the third quarter GDP data, business investment was almost not there. It was pretty much flat. And that's because businesses, and what we hear from them, are getting bitten by the fact that interest rates are so high and the cost of capital is rising.
So does that mean you're looking for layoffs as well, Dana? Or do you, I mean, has hiring, is it grinding to a halt in terms of your outlook?
Well, we do have payrolls getting to zero and even somewhat negative in the first half of next year. But that's, you know, consistent with, you know, a short and shallow recession. But we don't think the unemployment rate's going to shoot up. It probably will rise to around 4.2%. That's roughly 700,000 jobs lost. That's really not as bad as what we saw certainly during the pandemic or even during the great financial crisis, where it took 10 years to recover from the recession that happened in 2008 and 2009.
Dana, you know, it's interesting. I'm just looking at the 30-year, the bankrate.com 30-year fixed mortgage, 8.05%. What do your surveys show about the cost of housing and rents and all that type of thing?
Well, we do ask consumers whether or not you plan on buying a home, and they continue to say no. And we think a lot of it has to do with interest rates. We ask them, what do you think interest rates are going to go? They still think that interest rates are going to go higher. They're complaining about interest rates increases in the fill-ins when the write-ins. And so I think consumers are feeling the bite. Certainly when it comes to buying a car, it's more expensive. Buying a home, that mortgage rate's elevated. And even if you own a home and you want to swap out, you're going to get a much higher mortgage rate now than you did probably when you purchased it. So interest rates are definitely feeding into the psyche of consumers as well as inflation.
Hey, Dana, thanks so much for joining us. Dana Peterson, she's the chief economist at the Conference Board, kind of breaking down some of the consumer confidence numbers that came in today. A little bit better than expected, although still below where you want to see them.
And where they were last month. So they've come down, as Dana pointed out. It's still a drop.
Yep. All right, Matt, so here's one of my big questions as it relates to the EV business. What is the real demand out there?
That's a very good question, and it's one I think people are increasingly asking, including executives at the major automakers.
Because I'm just going back a year, and I don't think there was that much of a question about demand because we had all the big OEMs saying, it's true, we're going all in, and it seemed to be Tesla was right.
I mean, a year ago I spoke with Fatih Birol, who runs the International Energy Agency, and he said, listen, in 2023, 1 in 5 new vehicle purchases is going to be an EV. So, I mean, we were all in. And the problem now is that it looks like early adopters have gotten their EVs. You know, rich people that have multiple cars have gotten an EV. You know, if for the luxury, for the fun toy purchase, it's out of the way. And now who's left to buy one? Right. And as a result, you're seeing Tesla cutting prices dramatically. You're seeing Ford follow suit and cut prices, and they're already losing $4.5 billion a year on these vehicles.
Right, and that's where I wanted to go because I mean, when they initially came out with their number was $3 billion. That's right. And I thought, wow, that's huge, and it's a big commitment. But now 4.5. Now, if I'm on the board or I'm the CEO, I'm thinking, all right, how fast do we want to go towards this stuff? If it's going to cost us even more in terms of losses, and that ultimate demand, I just haven't seen a great analysis of what the ultimate demand is out there for these.
No, but you're seeing fantastic proof of demand for internal combustion engines, right? Because consumers are willing to pay out the wazoo for big gas engines. By the way, this week I'm driving a Dodge Durango Hellcat.
Oh man.
So it's a family truckster, right? It's a 3-row kid hauler, but it has a supercharged 6.2-liter V8, which makes 717 horsepower.
Okay, so you can drive the kids to the Halloween party
quickly,
doing 180 miles an hour?
I mean, I hope...
That really strikes me as super practical.
I hope people continue to be careful when the kids are in the car. I certainly am. You know, it fits a rear-facing car seat. I put Edna in the back, and I drive like a normal person. When she's not in the car, then I'm driving like a bat out of hell. And that thing is just so effortless and so fun. By the way, did you know that Hannah Elliott and I have a new podcast about cars?
No, tell us about it.
Yeah, it's called Hot Pursuit!
Nice!
Exclamation point. It's kind of a play on words because Hannah Elliott is our luxury car reviewer out in LA. She writes for Bloomberg Pursuits. And we have worked together for years, for a long time, but we tend to disagree on almost everything in a nice way, which makes for a fun podcast. So every Saturday morning, a new episode will drop of Hot Pursuit with Matt Miller and Hannah Elliott.
Oh, awesome. I will definitely check that out because I know two crazy car people. What could go wrong? This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Shares of JetBlue, well, they are falling after a worse-than-expected loss due to constraints on its operations. Bloomberg's Isabel Lee has details.
They're banking on international travels for their growth in the next quarter. So this just really shows that some U.S. carriers have been hit harder than others. But overall, the industry is just in general grappling with the waning demand, aircraft delivery delays, and parts shortages. And this also comes in the middle of a crackdown on airline consolidation this week, in which the U.S. Justice Department claims that JetBlue's bid for Spirit would limit flight operations.
Shares right now, they are down about 14%. Weight loss drugs like Mounjaro aren't Eli Lilly's only focus. The drug maker is looking to gain the rights to treatments for cardiovascular disease. Bloomberg's Joan Doniger has that story.
Eli Lilly wants to work on heart disease with gene editing technology. It is buying the rights from Beam Therapeutics to come up with new heart disease treatments using that experimental technology. It'll pay Beam $200 million up front and make a $50 million equity investment in the company. If the treatments work, Lilly will pay more.
Shares right now, they are down nearly 3%. And fewer people are getting Pfizer's COVID shot and Paxlovid pill, and that's led to lower sales. Pfizer's third quarter results missed expectations, with sales falling 42% to $13.2 billion. The loss is Pfizer's first on an adjusted basis in at least 33 years. Shares are down about 1%. And Amgen raised its full-year revenue guidance after closing purchase of Horizon Therapeutics earlier this month. The company says revenue will be $28 billion to $28.4 billion for 2023. Those are the stories we're working on. I'm Lisa Mateo.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 edging higher by a point, but still on track for a third monthly drop. That's going to be its longest losing streak since March of 2020. Among the most active, you have Tesla up about 0.7%. NVIDIA shares down 2.5%. And Vans owner VF Corporation, that's a standout, plunging 12%. They pulled their guidance. As the Fed's two-day meeting underway, we saw employment costs unexpectedly accelerate in the third quarter. So that's heightening concerns that a strong labor market is going to keep inflation above the Fed's target. And right now, the S&P 500, 2 points higher at 4169. Dow Jones Industrial Average, 18 points lower. The NASDAQ 100 down 17 points. That's down 0.1%. Two-year yield unchanged, 5.06%. The 10-year down 5 basis points. That's at 484. The only graph plot GIP annotation that I do is from the peak of the S&P 500 to today's decline, or where we are right now, down 14% from the all-time record high.
All-time record high. All right, John Tucker, thank you so much. We appreciate that. Well, here, we bring you news throughout the day here on Bloomberg Radio. But now you can get the latest news on demand whenever you want it. Subscribe to Bloomberg News Now to get the latest headlines at the click of a button. Get informed on your schedule. You can listen and subscribe to Bloomberg News Now on the Bloomberg Business app, Bloomberg.com, plus Apple, Spotify, and anywhere else you get your podcast. We're right smack in the middle of earnings. Markets digesting them on a daily basis. Got some more earnings after the close today. AMD, then, of course, Apple after the close. We want to go across the pond and see how things are over in Europe with earnings, with markets. Where's the performance? Where's the risk? And we do that with one Tim Craighead. He is the Director of Research, and he's also a Senior European Strategist for Bloomberg Intelligence, joining us from Queen Victoria Street, the European global headquarters of Bloomberg, and it is a smoking hot building, just crazy, the building over there. Hey, Tim, thanks so much for joining us here. Give us the headlines. Just step back 30,000 feet for our listeners and viewers who maybe aren't really up to date on how the European markets have been performing this year.
Yeah, well, we have been behind the U.S. from the standpoint of market performance. We don't have the big tech that's driven the S&P 500 back up over the course of into autumn. That said, we also don't have the big tech that's been under pressure since the July-August peaks. And so while the U.S. is certainly taken a pummeling, and we've sold off, we've not sold off as much. So that's sort of the quick synopsis.
So we've taken a pummeling, you've sold off, but not as much. Today we learned, though, that your third quarter showed a contraction in growth, and we were growing 5%, buddy.
Hey, there you go.
No, I'm kidding. Obviously, backward-looking isn't what matters, and as Caterpillar, I think, proves today, people really care about the outlook, as if we didn't know that already. How is the outlook for European earnings compared to U.S. earnings?
So, Matt, I think it's really interesting thinking about the earnings picture. Again, the compare and contrast. The U.S. went through a few quarters of earnings contraction while Europe was still gaining. A lot of that earnings contraction in the U.S. was big tech oriented. And what we're feeling now in Europe, and we will see an earnings decline again this quarter, is actually a lagging impact of the decline that we've seen in things like energy and metals prices, which are really big over here, much more so than they are in U.S. markets. The thing I don't think either market has necessarily felt is the full impact of the spike in interest rates that we've had and how that's going to have an impact on consumer and businesses as we go into 2024, which does play into an awful lot of the earnings commentary that we're hearing through the reporting period. Just to give you a couple of numbers, we're about halfway through here in Europe, a little behind where you are in the U.S. It sounds okay that we've got about 50% of the companies that have beat earnings expectations, about 35 that have missed. But in fact, that's the worst performance from the standpoint of beats versus misses that we've had since the pandemic lows. So I would categorize this as a pretty disappointing earnings season.
Hey, Tim, talk to us about valuation. Where are you guys over there in terms of valuation right now?
Yeah, so you look at the broad European market, we're at 12.5 times forward earnings. It's down from recent highs of 13-ish, clearly far below where the U.S. trades. You can find markets like the German DAX index that's retraced all the way to 10 times forward earnings, and that's with a heavy dose of the big German auto companies that are facing increasing pricing competition and EV competition from China. So, it's clearly there's a value tilt from the standpoint of an absolute multiple across the European markets. But I'd also say, and it's true from a U.S. perspective as well, with interest rates being as high as they are, and they've certainly ratcheted up here market by market over the course of the autumn, that does take a toll on what you're willing to pay in terms of market valuation. So what would seem cheap from an absolute level, 10 times, 12 times a year ago, now isn't quite so cheap on our fair value work because interest rates are simply higher.
Yeah, I wonder how important China is to European earnings. And I know they haven't fully penetrated the entire continent, but when I was over there, they had made their way up through Africa and straight to the tip of Italy. Is it a bigger driver of, well, let's say revenue growth, China, than it is for U.S. companies?
Significantly so. The recent analysis we did looking at the stock 600, 80 of the 600 have got overtly easy to define significant contribution. If you add it up, it's about $450 billion in revenue. These companies aggregate to be about 30% of the European market in terms of index weight. So any way you want to cut it, there's a lot of companies, they're big companies, and it's a lot of revenue. And what we're seeing in the third quarter, maybe no surprise given the faltering, stuttering economic growth in China, is that business is also faltering a bit. I already mentioned the German autos as a case in point. Contrast that with Stellantis today, which doesn't have so much China exposure, but more U.S. exposure, and it was a little bit better. The luxury good companies have talked about weakening China economic activity, and there are several others that are showing that there are signs of weakness. Now, two things other to mention on China. This was still an easy comparison for 3Q. Remember, they didn't open back up until October and November last year. So it's really the fourth quarter that is going to be a more difficult comparison and on into the first quarter of next year. So if things are still stuttering, that business is going to be more of a challenge. And the other thing, obviously, thinking about 2024, the more pressure there is on the economy, the more likely there's going to be fiscal and monetary measures to stimulate the economy, which might all of a sudden turn this around as we look into the back half of next year. And clearly the markets will discount that. Right now, everybody's focused on current weakness. That may be short-lived.
Hey, Tim, you travel all around the continent, all around Europe, speaking to institutional investors. What do they want to know? I mean, what's kind of the common question, top question you get asked?
Yeah, you know, Paul, I guess a couple things come to mind. I was just in an event last week in Frankfurt, and at this point, it really is all about the macro outlook and what's going on with monetary policy. When is the pivot going to happen, and how much of that pivot does then translate into a reduction in things like 10-year yields, because it's not an immediate feed-through. But that's crucial, because the higher we are, the longer we are on interest rates, the more of an impact there is on business and consumer, and you know that's a huge pressure point for the 2024 outlook.
All right, in suburban London, near your pad, what's a good pint going to cost me?
A good pint when I go for Halloween today, Paul.
There we go. Thank you very much.
Is going to be about £7 for a pint.
Wow, £7. And do you do like Guinness extra cold, or do you have them pull you an actual ale from one of those old school taps?
I like the cask ales, definitely.
See? Old school. Yeah, delicious.
And best thing is a Trappist ale, though, from Belgium. That's the best beer.
That's the best beer. Hey, are you still avoiding the congestion tax in London by riding your bike to the office?
I do. I rode this morning.
See, he's one of those people that
and I'll ride home this afternoon.
See?
That's smart. I'm going to avoid the congestion charge in New York by getting a garage on 60th Street.
Yeah, we're going to get John Tucker a bike.
Yeah, I'm going to ride my bike at 2 o'clock in the morning. That'll work out really.
Through the Lincoln Tunnel at 2 o'clock in the morning.
I don't think they allow bikes in the Lincoln Tunnel.
All right, Tim, thanks so much for joining us. As always, appreciate it. Tim Craighead, he is the Director of Research over there in London, and he's the Senior European Strategist for Bloomberg Intelligence. Tons of experience in the equity markets. Morgan Stanley did a little hedge fund work, and then we nabbed him at Bloomberg Intelligence back in the day. So he's doing great work for us over there and leading our European business along with Sam Fazeli. S&P 500, that's pretty much unched on the day. A lot of work for not a lot happening on the index front there. The S&P, the NASDAQ is off about 0.2% there as well. Right now, let's head down to Washington, D.C., because Amy Morris has got world and national news for us.
All right, thank you, Paul. Defense Secretary Lloyd Austin and Secretary of State Antony Blinken are taking their case to the Senate to find funding for Israel and the Ukraine all at once in the name of national security, and protesters interrupted. Secretary Blinken was interrupted several times during his opening statement before the Senate Appropriations Committee. The Biden administration is asking Congress for $105 billion to support Israel, Ukraine, and other security priorities. Israel's military engaged in fierce battles with Hamas militants deep in the Gaza Strip, firing at targets in Lebanon in retaliation for attacks by Hezbollah. The United Nations warned that the situation in Syria, which borders Israel, is at its most dangerous in a long time as Israel increases airstrikes on that country as well. Courts in Colorado and Minnesota are hearing challenges this week to keep former President Trump off their presidential ballots. A group in Colorado believes the former president should be prohibited from running in future elections under the 14th Amendment. Meanwhile, the Minnesota Supreme Court will hear oral arguments this week in a similar case. Okay, cold weather is coming, and for some parts of the country, it's already here. In Texas, for instance, cold air has pushed in from Canada. San Antonio's Haven for Hope homeless shelter spokeswoman Terry Belling says that this week is going to be a good test of their resources before the really cold stuff hits.
We do have some additional capacity available, but not a ton of extra space.
The shelter has teams out on the streets today handing out jackets, hats, and socks, the most requested item. And by tonight, more than 70% of the country will be experiencing below average temperatures. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker on the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, you have 9 of the 11 major industry groups in the S&P 500. They are higher, the index overall, just 2 points higher right now. Dow Jones Industrial Average down 22 points. The NASDAQ 100 down 21 points. Real estate financials leading the way for the S&P 500. You have tech shares. Right now, they're the biggest drag. The third quarter earnings reporting season rumbling on. It's been kind of a rocky start for some of the companies. Caterpillar shares under pressure, down 5%. Now, even with the third quarter profit beat, the maker of mining equipment, construction equipment, has a pretty tepid outlook for the fourth quarter. Meantime, Russ Kostrich at BlackRock is urging investors to be very selective.
I do think you've got an opportunity if events don't erupt in the Middle East for year-end rally. But right now, the byword we're using in every meeting is idiosyncratic risk. In other words, rather than focusing on taking a big equity bet, picking your spots, looking for the parts of the portfolio that align with long-term themes, rather than just saying, let's go out and buy lots of stocks.
Meantime, central bankers and investors have some more information today on labor costs for employers. Worker compensation increasing 1.1% during the third quarter, higher than expected. Apple is going to report earnings later this week, and ahead of that, investors in the options market buying more protection against price drops. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. All right, let's take a look at these markets. Where do we go from here? We're right smack in the middle of earnings. People starting to think about next year, where to be positioned. Our next guest thinks about that stuff as well. Lucas Tomicki, he's founder, managing partner of LRT Capital Management. Lucas, thanks so much for joining us here. Give us let's start off by just getting a sense of how you guys deploy capital to LRT Capital Management. Kind of what's your strategy that you guys deploy?
Hey, Matt, thanks for having me. Yeah, to give you a quick overview, we're really trying to focus on business quality and business resilience. So to us, quality means three things. It means some kind of durable competitive advantage. It means the ability to grow and reinvest capital at high incremental rates of return. And it means management teams that have demonstrated a good track record of allocating shareholder capital.
All right, so looking at all those variables, what do you like?
Well, I think, from a macro perspective, we're likely heading towards an economic slowdown, if not an outright recession. And so today, the theme for me is really investing in resilient companies. So the three companies that we like most today are Chemed, which is kind of an odd business. They own two businesses within it. We also love Elevance and TriNet.
All right, let's start with Chemed here. Tell me kind of what business they're in. I'm looking at the stock here. It is an $8.5 billion market cap company stock. Stock's up about 10% year to date. So tell us about the call there. What do they do and what's the investment call?
Yeah, so Chemed is a very odd company in that they own two businesses that are completely unrelated to each other. They own Vitas, which is a hospice care provider, and Roto-Rooter, which is a commercial plumbing service.
Yeah, I don't see the connection, but go on.
No, there's no connection on the surface, but the real connection is that these are very resilient businesses from a macroeconomic perspective. So Vitas provides end-of-life care effectively, and Medicare, of course, is the largest customer. And so for most people, the statistics say you're spending somewhere between 25 to 30% of your entire life's healthcare cost just in the last few months. When you're effectively dying in the hospital, getting very expensive care, very expensive treatment. And that's a very big cost for Medicare. And frankly, not everyone sees the benefits of that. So many people opt for hospice care, which is effectively palliative care where you end treatment and you're just receiving medication to manage pain and improve your comfort of life. And obviously that saves costs, and frankly, a lot of people see that as a more dignified way to go. And
just looking at this, Lucas, you just don't see many corporate structures like this anymore. Just pure holding companies, particularly ones that own just two businesses. What kind of attracted you to the company?
Well, I've followed it for a long time, and I don't think I'm the only one. But what frankly attracted me to the company is up until a few years ago, their website looked like it was straight from the 1990s, and that might sound counterintuitive, but that was to me a very odd signal that this is a company that's really focused on business operations and not promoting things. And so, generally speaking, we like non-promotional, down-to-earth kind of management teams.
And it's up 87% over the past 5 years, up 10% this year, 87% over the past 5 years total return. It's done well. The Roto-Rooter business also, these are two businesses that people are never going to not need, if I can split my infinitive just to make the point. And I get that. Do they spin off at some point, one or the other? Do they break into two, do you think?
I think that's long been the theme and the thinking. I frankly don't have a problem with the business the way it is. They have opportunities to deploy capital, primarily in the Roto-Rooter business, by buying out franchisees from some of their territories. And then they have opportunities to buy back stock when the shares are trading down. And as you mentioned, the stock is up a little bit this year, but that's largely happened last week on the back of good earnings. So, you're going to have ups and downs, but it's a very resilient business. They've grown about 4% per year in terms of revenue, but they managed to translate that into a 14% EPS growth over the same, last 10 years or so.
All right. How about ELV, Elevance Health, another healthcare name?
Yeah, so this is Elevance. This is the former Anthem insurance business.
I know that.
So you may have heard of it as Anthem. They rebranded themselves. We love the industry, broadly speaking, the health insurance industry. It's a very consolidated business. There's 5 players that command the majority of the market, a couple smaller ones. And, this company is called a health insurance company, but that's really a misnomer. Only about 10% of what they do is tied to carrying risk. The majority of their business is managed care for the government, managed Medicare, Medicaid, and corporate accounts in which companies self-insure. And so there's very little insurance risk in this space. It's really a health administrator, if you will. And it's so regulated that they're frankly not allowed to even, the amount of profit they're allowed to make is regulated as well. And you see that between all the companies, there's very limited competition, and call it GDP plus growth, largely tied to the growth in healthcare costs.
We get that one. Let's get to TNET, TriNet. It's also kind of an employee benefits company, right?
Yeah, so this is slightly different. It's a very small company, about a $5 billion market cap. So this is a company that serves small and medium-sized businesses that are looking to get employee benefits. And employee benefits may mean many things, primarily HR, health insurance, disability insurance, etc. But in practice, 90% of what drives their business is health insurance. So what they do is they effectively get a bunch of small employers with small employee numbers. They get them together and, using their bulk purchasing power, acquire health insurance at better rates, pass the savings on to their customers, and keep, of course, a small part of those savings for themselves.
Hey, Lucas, thanks so much for joining us. Appreciate listening to some of your thoughts there on the stocks that you guys own. Some pretty interesting names, some good performers. Lucas Tomicki, he's a founder and managing partner of LRT Capital Management, one of those folks who's putting money to work, who, as Tom Keene would say, has the courage to be in the market. S&P 500 pretty much unchanged on the day. NASDAQ off about 0.3%, but at the index level, not a lot happening there. Of course, a lot of movement under the surface there as companies report earnings for the next week or so in size. We're going to have more coming up. This is Bloomberg. Good morning. Let's go to Lisa Mateo for some company news.
Hey there, Paul. Shares of VF are lower after the company withdrew its guidance for the fiscal year. Bloomberg's Katie Greifeld says it comes after VF introduced a turnaround plan to cut costs, reduce debt, and overhaul its Vans footwear brand.
In that specific unit, revenue dropped 21% in the fiscal second quarter, and the company warned that performance isn't expected to improve in the fiscal second half. Now, as a result, they're reshuffling the C-suite as well. Vans president Kevin Bailey going to step down. CEO Bracken Darrell will lead the unit in the interim while they search for a replacement.
Shares right now, they're down about 14%. And three of the world's biggest brewers are confident they can hit profit targets this year, thanks to higher prices, offsetting weaker consumer demand. Carlsberg stuck to its forecasts. Last week, Heineken